Good morning, everyone. It's 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. Here are three things that you need to know to start off your morning. Delta kicks off earnings season with a bang, hiking its full-year outlook on record quarterly earnings. Adjusted EPS comfortably beating the street at $2.68 versus the $2.40 that was expected. Adjusted revenue coming in at $14.6 billion. CEO Ed Bastian expects the consumer to stay strong, forecasting a jump in revenue of as much as 14% on the year. Shares in the airline on a high this year, up almost 50% since the start of 2023. So can the positive momentum continue? We hear directly from the CEO this hour. Plus, PepsiCo brushes off a consumer slowdown, beating the street with results and hiking its outlook. Adjusted earnings per share landing at $2.09 versus the $1.96 expected. The company behind brands like Doritos and Lay's chips now expects 10% organic revenue growth in 2023. Volumes took a hit as higher prices started to weigh on demand. Its Frito-Lay North America unit bucks that trend, however, with 1% volume growth in the quarter. We speak with CFO Hugh Johnston this hour. And Bob Iger stays on. Disney CEO going to remain in charge until 2026 as the entertainment giant contends with issues on various fronts, from cost cuts to battling a box office slump and making Disney Plus profitable. His in tray is pretty full here. Iger returned to the fold last November, replacing embattled former CEO Bob Chapek, and he's in the midst of executing a board restructuring plan that shifts the focus back to its creative leadership. Disney's board has made clear that picking a successor to lead the company will be a key task. Well, Delta starting airline results off on a high note. Shares popping pre-market trading after reporting record high quarterly revenue and profits in its second quarter. The airline beating on the top and bottom line. Revenue came in at $14.6 billion versus the $14.44 billion estimated, and earnings per share that topped the estimate of $2.41 with an actual of $2.68. The company also raised its full-year outlook as the revenge travel boom that continues to be a tailwind for much of the sector. I got a chance to speak to Delta CEO Ed Bastian about these results, asking him how long he thinks this surge in travel spending can persist.
I think it's going to persist for quite some time. When we look at the health of our consumers, which is principally a premium consumer, we look at their top priority for spend is in premium travel experience. When you look at on an economic level, the flip that we've seen where goods is overtaking services in our economy, and services are coming back, and actually the reductions in good purchases are funding that service spend of returning. We think there's easily several years of this continuing because the pandemic was a 3-year phenomenon. I expect on the other side of it, we're going to see just as long a recovery back to the norms where we were previously.
And we've got more of that interview ahead on Yahoo Finance. Just kind of two things to add as context here too, Julie, and the conversation and even what came through from the company's earnings release that dropped this morning. There's two themes here. International travel, that's remaining extremely strong for the broader industry and especially for Delta, where they're leaning into this premium consumer, and the consumer on their loyalty basis that's about 10 years younger now in the Sky Miles loyalty base that they're building up here too. Another consecutive quarter of record growth in that Sky Miles monthly member acquisition as well.
I mean, it's also interesting on the expense side of the equation that things are improving there. The company talked about an inflection point in on costs in the statement, so that doesn't hurt.
No, not at all.
At the same time that they're seeing this demand that is persistent, if costs are coming down, that is helpful.
Yeah, and especially knowing how much for fuel price fluctuations, how customers look to some of those instances, or even where there have been negotiations with pilots unions to ensure wherever the customer may ensue more of or see some of the higher prices. For Delta, the difference there is that when you have the consideration of, number one, the pilots, they're still working through kind of this backlog and making sure that those pilots are getting out of training and putting them into the routes and added them to the capacity schedules as well. But then on the fuel price, this company is a little bit different as they have their own refining practice too that helps them mitigate some of the costs that would have been incurred by other airlines on that fuel price fluctuation too.
All right, well, we're going to be playing more of that interview, I believe, coming up a little bit later on. We getting the first big earnings reports of the season, Pepsi and Delta. They've set a high bar for their sectors, raising their guidance as consumers continue to shell out. Can the trend continue? Brad, you talked to the Delta CEO, of course. He seems skeptical that other sectors and companies would be able to clear the bar that Delta set.
The earnings season is going to be a little choppy. I think you're going to see some industries, some consumer-facing industries that principally, whether it's retail or home improvement or potentially in the cargo world, where you're going to see some difficulty. You're going to find other industries that are service-oriented, that are providing opportunities that customers haven't had the time because of the pandemic to exploit and to utilize. And I think you're going to find some mixed messages here.
And he also said that earnings season could be choppy. Joining us now, Lee Farage, head of macro strategy for North America at State Street. Lee, when you look across the earnings season, is there a particular company or sector that you look to sort of set the tone or be emblematic or a bellwether of what we're going to hear overall?
Not really from my perspective. I look at it from a macro point of view. I'm a macro strategist, so I'm looking for clues about the consumer. Is the consumer still strong? Do companies think they're going to stay strong, as we just heard from Delta? I'm also looking at, are they struggling to hire people? What's happening on the wages front? The labour market is key in all of this for me, so I want any clues I can hear on the labour market from them. And then finally on prices. Are they facing still rising prices for their input costs? And are they able to pass them on? Are they confident about passing them on? Those are the things I'm looking at, particularly labour market, particularly on prices, and then overall strength of the consumer. And what they project going forward is really important for me from a macro perspective.
Could one of the other themes or bellwethers be what companies don't say or don't lean into with regard to what we heard from bank CEOs last quarter saying Q3 2023, recession's on. That's what we're forecasting. That's what we had been knowing to expect because of what they had said back then. If we get any type of different tone or commentary, does that kind of lift the markets on the easing of some of those pressures, or at least the thought of a Q3 2023 recession?
Yeah, I think it does, and I think you will see less talk of recession in this earnings season. We've already heard, you mentioned Delta and PepsiCo, right? The two of them have come out and talked about a strong consumer, talked about a strong outlook going forward. If we get more of that and less talk of recession, that's got to lift the mood in the market for sure. The problem with it is, though, everyone's looking at it from that side and everyone's talking soft landing. If we don't have a meaningful slowdown, how does inflation come down? It was a good number yesterday, but we're still at 4.8% core inflation. We still have very strong wage growth. If the economy stays strong and doesn't slow, how do we get inflation to 2%? And that's what's going to be troubling the Fed.
Yes, that is a conundrum, to be sure. We're going to talk more about that in a moment, but just to sort of continue the earnings conversation, do you think going into the season it is a low bar that companies will be able to easily go over, or a high bar that'll be more difficult for them to achieve?
It's a good question. I mean, I would have said a little while, a month ago it was a low bar, but now, given the price moves we've seen over the last month, I think there's a lot of good news baked into the price now. So that bar has definitely gone up. And I think, I wouldn't disagree with the Delta CEO saying it's going to be a mixed bag. You're going to see some very good results like theirs, but then you're probably going to see some disappointing ones as well. Overall, I think the message is going to be one of resilience. I think overall the earnings season will be good. But I think I would agree. I think there's going to be some big winners and losers, and the bar is much higher than it was a month ago.
And that resiliency, from your perspective, also carries through to the consumer as well?
That's right. Yeah, most definitely. I mean, we're still seeing that in the consumer.
Interesting. And then just to kind of add on to that and go further with how different companies are talking about their consumer, there's, of course, the individual consumer or the household, but there's also their engagements with other businesses, too, who have looked across either their cost restructuring over the past year and even where they're spending on some of the applications, software, systems, tools like that. Are we set to see that flip this earnings season, where companies are talking about other businesses having more of a propensity to spend on some of the things that are going to help shore up cybersecurity or shore up their, internal collaborations even?
I think that's a really good question, because that will tell us a lot about company confidence on the economy going forward. because that's the sort of thing you spend money on if you're confident about the outlook. If you think we're going into recession, you're not spending money on that stuff. You're pulling back on those sort of costs. But that will be a really interesting bellwether of the whole thing. Are they spending money on that sort of ancillary sort of investment that is a sign of real confidence going forward? And even if they say they're confident, if they're not spending on that, maybe that's a sign that they're not as confident as they say they are.
All right. Stay with us, Lee. We've got much more to discuss here this morning. It's Lee Farage. We've also got to talk about shares of Disney. Up in pre-market trading this morning, the company announced current CEO Bob Iger will stay on through 2026. What does more time with Iger at the helm mean for the company's immediate future? That's the big question here. And Yahoo Finance's Alexandra Canal joins us with more on this. Hey, Ali.
Hi, guys. I think it means a heck of a lot, right? Bob Iger, he stepped back into that CEO position in November. Already, he's enacted a lot of changes, restructuring costs of $5.5 billion, including $3 billion in content costs. He laid off 7,000 workers over the past few months. So there's a lot that he's done. However, he said that there's still more transformative work to be had, hence the reason that the board wanted to expand his contract by another 2 years. He just did a 45-minute interview with CNBC earlier this morning. That just wrapped up. And there are a few highlights for me that I want to call out. One, he said that the company is going to take an expansive look at the linear business. He didn't elaborate what the word expansive means. He said you can interpret that what you will. But to me, that means a lot of M&A, potentially unloading some of those assets. And that includes the network, the cable businesses like Nat Geo, FX, ABC. He said that they might not be core to Disney's business going forward. So that's something to look out for. Along with that, ESPN, he said that's in a very different position compared to all the other linear networks. He said he's very bullish on sports overall and that he knows that ESPN is going to go direct to consumer. He said he even knows when, but he's not prepared to say that at this point. But in order to make that happen, he's open to a strategic partnership, someone that maybe could bring value on the content side, on the capital side. So that's something to look out for as well. He did mention Apple's VR headset and how that could create some opportunities. So perhaps Apple could be a strategic partnership there. And then separately, he spoke about the parks business and the current battle with Florida Governor Ron DeSantis. There was a recent Wall Street Journal article out that suggested the park business is slowing. He said that's not accurate, that the park business is robust. He's very confident that that will continue to help Disney grow and be profitable. And he said that the political firestorm that's happening right now is not impacting attendance at the parks. And then finally, on the Hollywood strike, he had some spicy comments there. He said that it's, quote, very disturbing to me what's happening, considering where media is as a whole. He said this is a very difficult time for media and that the writers and the actors, they're unrealistic in their demands at this point. Yeah, given where we're at with, the changing media landscape. So he had some choice words for those actors that are expected to strike any minute now, really.
Right, they're voting.
They're voting to strike, and the writers there already have been striking for the past few months.
Right.
So no end in sight there.
Okay, there's one more thing that we have to talk about with the implications of him staying on longer, and that's succession, right? That whoever is going to take his place is going to have to wait longer, but the implication is also that he still hasn't figured this out. And already there was one botched succession, right, in the form of Bob Chapek. So what are the implications there?
He did say, quote, succession process won't stop. It's going to continue, and it should. So that's something he said during
obviously
that
it should.
CNBC
They have to figure it out.
But that was the only thing he said about succession. And really, I feel like there are so many other issues at this company. We didn't even talk about Hulu. He said that Disney definitely wants to purchase the Hulu stake from Comcast, that Hulu is going to help the streaming business be profitable. There's that issue. There's just overall what we're seeing with traditional media, the linear business. There's so many things going on that it almost feels like succession is a little bit on the back burner at this point, especially since he has until 2026. Right. We'll see, though. Obviously, that's something that's going to take some time, and we'll see if there's internal candidates, external candidates, who could be the next Disney CEO. And is Bob Iger, is he going to extend it another few years? Who knows at this point? He said originally he's only on for 2 years. Now that's changed.
Yes, first time we've heard that for sure.
Yes.
Right, kicking the can down the road. Maybe we'll get as I was responding to our own Brian Sazi earlier, or yesterday on this news, maybe we'll get a Jabba the Hutt origin story. I don't know. Perhaps. That's some good that can come out of this. Thanks so much, Ali. Appreciate it. Also, we're tracking shares of Pepsi this morning. They are on the move after the company saw net sales jump over 10% in the second quarter and raised its full year guidance. The food and beverage giant wasn't able to escape the impact of price hikes, though, with overall volume in its food and beverage divisions taking a hit. Hugh Johnston, PepsiCo CFO, joins us now alongside Yahoo Finance Executive Editor Brian Sazi. Hugh, great to speak with you once again, as always, on the back of these earnings reports. First, kind of broad strokes here, some of the larger catalysts and your key takeaway from the quarter.
Yeah, good morning. Great to be with you guys as well. Look, two sort of broad themes here. Broad theme number one is our top line growth continues to be strong and very broad based. Snacks and beverages both grew over 10%. North America and international both grew double digits. And overall, obviously, we've had a very strong first half of the year. Second theme is productivity. We saw margin improvement both in the first and the second quarter, not driven by pricing, but in fact driven by productivity. So the investments that we've made in recent years in digitalization, in automation, and in leveraging global business services to standardize the company, that's now really manifesting itself in a more efficient company and more margin improvement. And that's something that I think will sustain not just for the back half of this year, but into 24 and beyond. So we're quite optimistic about how the company is performing right now and the fact that the initiatives that we've taken on are actually paying back in our results.
Hugh, it's Brian here. Good to see you. A couple months ago, we were in the same spot, probably wearing different clothes, talking about a guidance raise that I think stunned a lot of people in the street. Now we are back in here today, different clothes, talking about another guidance raise from a company in PepsiCo. Hugh, you know this very well, doesn't normally come out here and raise this earlier in the year. And if you have, maybe not by this magnitude. Are there parts of the business, cost side, product line that are surprising you on the upside and surprising the team?
Yeah, in particular, I'd certainly point to the Frito-Lay business, which is really having a very, very strong year. And it's a product of a lot of what we've been doing down in Frito-Lay, expanding the product portfolio into a broader array of foods, permissible snacking and more food-like products, or more center of the plate food-like products. In addition to that, we've really been putting quite a bit more advertising into the business as well. Across PepsiCo, the advertising budget went up to 50 basis points in the second quarter, and that's something that we think will sustain. So the combination of the investments in the brands, the investments in innovation, and then further gains in distribution as we've made the supply chain both further reaching and more resilient, driving the Frito-Lay business very, very strongly. And there's lots and lots of opportunity left there. In addition to that, international was up 15% in the quarter. So in a time where obviously there's a lot of turbulence in the world, people are coming to our products for that simple treat, that affordable luxury that's frankly making them feel better and enjoying the brand imagery and the products that we create.
Hugh, also the last time we talked to you, Julie here, good to see you. We talked about pricing. We talked about pricing going a bit higher, and you're saying that this time you really saw the gains in Frito-Lay driven by productivity. Where are you on the pricing front? Are you guys done raising prices this year? Have you raised them as much as you've been able to?
Yeah, our pricing right now is in line with our commodity inflation. And that's something I do want to emphasize because it's really not the pricing that's driving the margin improvements. Pricing and commodities are basically exactly the same. As for the balance of the year, I would say TBD. The fact that commodities have moderated, they're still inflationary. And I suspect even as we go into next year, commodities will still be inflationary. And with that, prices will still increase. Now, the rate of increase will come down, but prices will still increase, certainly into next year, and we'll see how the balance of the year plays its way out.
I mean, not all commodities are increasing, Hugh. Wheat prices are down year over year. Oil prices are down year over year. There's quite a number of commodities where there's been a lot of relief. Does that mean that people are going to get lower prices on some products?
Well, no, our basket of commodities, and keep in mind, there's no commodity that even accounts for 10% of our portfolio. So we touch a whole variety of commodities. Our basket of commodities will continue to increase in price. And one thing to keep in mind as well is we tend to forward buy on commodities by about 9 months. It gives us predictability in terms of our cost structure. So anything that you see happening right now won't impact us until about 9 months from now.
Hey, you're almost coming up on that 1-year anniversary of the investment in Celsius. It was a big play for you guys in energy drinks. Since then, I'm seeing this stuff all over the place, new flavors, you name it. We also have Monster out there purchasing up the bankrupt Bang brand. I mean, do you want to make Celsius fully part of your portfolio and realize even greater value from what looks to be a brand that is very much in demand?
Yeah, Celsius is a terrific partnership for us. I think when they joined the PepsiCo distribution system, they were about a 2 or 3 market share, and I think in the recent couple of weeks they probably have gotten close to 10%. So I think we're both doing the things that they do best. They're doing great products and great branding. We're doing great execution in the marketplace and great distribution. I like the deal that we have right now, and I think this deal is going to serve us well for a number of years to come.
Any plans on increasing perhaps the investment there, or if you're content with the deal as it is, any plans to change, expand, enhance?
We may see things evolve over time, but nothing material that would impact the financials in a substantive way. I think we've got just about the right transaction right now. We may refine a few things at the edges, but by and large, I think we're pretty good.
Hugh, I also want to ask you about caffeine content. And I ask because Senator Chuck Schumer earlier in the week was highlighting the caffeine content in a competing beverage called Prime, which he said was marketed to children. We're showing the caffeine content of some drinks. He talked about 200 milligrams for that drink. That's also the caffeine content for something like Celsius. When you guys are making this stuff, how much caffeine is too much caffeine? How do you think about how strong a drink like that should be and who you market it to?
Yeah, I think the caffeine content is pretty consistent across a lot of the energy drinks right now, and that's sort of well inside what people are capable of absorbing. The good news on caffeine is people tend to self-regulate anyway. If you have too much caffeine, you tend to feel jumpy and all of those types of things. As I understand it, and I saw the press conference as well, the concern was more related to how and who it was being marketed to rather than the caffeine levels themselves. And that's something that obviously we've got some fairly strict guidelines on in terms of how we market our products and making sure that we're very, very responsible in the way that we market our products.
Tomorrow, Hugh, there's some reports that the WHO might put a label on aspartame as a carcinogen. Is there a cost to your business because of that? I mean, how disruptive is that to the portfolio?
Yeah, we don't think so, to be candid. I've been around PepsiCo for 36 years, and aspartame's been around for longer than I have. So, we've had aspartame in for a long time. There's been over 100 studies that have concluded that aspartame is a safe ingredient. There are 90 regulatory bodies in different countries, including the FDA here in the U.S., that have concluded that aspartame is a safe ingredient to use. So I don't anticipate us making any change. And frankly, I think that the predominance of evidence still suggests that aspartame is an ingredient that, obviously being 0 calorie, helps people with weight loss and is a safe ingredient to use.
Fair enough. Lastly, Hugh, before we let you go, I tweeted out this morning a long-term stock chart on PepsiCo. It really is up and to the right. You guys have not had an earnings miss since 2009. Now, you have one of the most popular tickers on the Yahoo Finance platform today for the second straight quarter. And I think there's a lot of new investors coming into your company and your brand. For those unfamiliar with your story, what is your secret sauce? How are you able to continue to drive just this steady performance when everything around you is not steady?
Yeah, I would point to a couple of things. Number one, we have a great portfolio of salty snacks and beverages, and those categories are terrific categories. They both grow at about 5% a year. They're big categories. They reach about $600 billion in size. So good size categories to start with. In addition to that, I think we have a team and a culture here at PepsiCo that's capable of taking these terrific assets and just continuing to steadily grow them. Growth in many ways is a real value inside of PepsiCo. It's not just an objective. We all think growth. And you put that culture together with this set of assets, and you get the stock chart that you saw. So I couldn't be prouder of being a part of this terrific team. And I think we've got a company that's best days are actually in front of us, not behind us.
And those shares are up about 2% in reaction to these numbers today. Thanks so much, Hugh. It's great to see you as always. PepsiCo CFO Hugh Johnston and Yahoo Finance Executive Editor Brian Sozzi joining us for that conversation. Thanks.
Thanks. Great to be with you guys.
Well, stock futures are gaining this morning, continuing the rally fueled by cooler than expected inflation data and bets on a less hawkish Fed. Big tech companies gave the S&P 500 its biggest boost. But can the rally continue? And can we sustain disinflation without recession? Here with us now is Lee Farage, head of macro strategy for North America at State Street. That's the key question you brought up just a few minutes ago. Can we continue to see disinflation without recession? Or conversely, without these companies that we've been talking about, if they're still holding the line on prices or even raising prices, we're not going to see this disinflation. Can we?
No, I mean, I think it's very difficult. I mean, there's a number of factors here. Wage inflation I mentioned before is a key element to this, and I'm looking at this earnings season to see where we are on that and what companies are saying. But there's also the thing that the inflation genie is out of the bottle in some ways. So it's very hard for companies to raise prices in the sort of post-GFC to 2020 period because prices just didn't go up anywhere. So very hard to pass price increases on. That's changed. Almost now people are accepting of higher prices. They don't like it, but we've got used to it. And so that genie is out of the bottle and you almost have to put it back in. And the only way you really do that is actually by slowing the economy quite strongly.
And so we had heard this term yesterday, a growth recession. What in reality does that look like? On the other side, if we do see a growth recession, and perhaps we can kind of put some terminology around that to kind of educate not just myself, but a few other viewers out there.
Yeah, I mean, I'd love to know as well. I don't know what a growth recession is. I mean, I think this is the latest sort of the balls of transition from soft landing to maybe a growth recession. This is the latest sort of narrative to justify valuations and where we are. Is we can't say outright recession. We can't say the economy is going to contract. So we'll go soft landing. Oh, maybe not soft landing. Let's go growth recession. I don't know what it is. I'll be absolutely honest with you.
Are we going to see a recession, at some point? And when is it now going to happen?
We are going to see a recession. I honestly believe that. And I think it's more likely a story for the second half of next year.
So if that's the case, and the only thing that will really put the inflation genie back in the bottle is a recession, is the market vastly underestimating the number of Fed rate hikes that are to come? Will the Fed be more persistent than we're expecting?
I mean, I think after the number yesterday, look, they're gonna hike this month. I still think there's a bigger chance than the market thinks that we get at least one more hike, because I'm not going to overreact to 1 month of data. I'm looking at the labour market. I'm looking at average hourly earnings. 3-month annualized average hourly earnings of 4.8%. It's the highest reading this year, right? So payrolls has slowed a bit, but we're still running about 250,000 3-month average. That's way above where it needs to be. So real earnings are now positive. We're hearing about the strength of the consumer. All of this means the economy keeps going, means you have this shortage of workers, means you have this wage pressure, and we hear companies will pass this on. So yes, you'll get some disinflation, and we're seeing that. But where does the disinflation stop? Where do we bottom out? This is going to be the key thing. I think we bottom out on core maybe 3.5%, 4%. That's not 2, right? So the Fed could, they'll go in July, they'll have a look at the data, and maybe they won't go in September, maybe it's November. But the big thing the market is getting wrong is we have about 100, 150, 125 basis points of cuts in for next year. That's not coming. That's going to be, the higher for longer is where we really need to rethink this. So even if we go into recession next year, as I predict in the second half of next year, if core inflation is still above 3, what does the Fed do? They can't cut rates. If you're serious about a 2% inflation target, you can't just jump in and cut rates when inflation's above 3%. And that's why I said before, I think you're going to see a recession that's not catastrophic, not deep like we saw, post GFC or even the very short-lived pandemic one, but one that could go along for a while because rates don't come down sharply as people think.
What is the risk of us, or the ramification of having talked about a recession for the better part of the last year plus, and then not actually seeing one until, if your projection reigns true, next year?
People get overconfident, and then we see valuations like we're seeing now, and we see people start to talk about a growth recession or a soft landing. We sort of, you get confident because you can say, oh, people said there'd be a recession in 2023. There wasn't one. There's not going to be one at all now. No, it's just later. Look, there's a number of factors why the recession didn't happen straight away. The shortage of workers, so the labour market's still strong. Excess savings from the pandemic, they're still there. I estimate about 1.2 trillion in excess savings from the time of the pandemic. And the third thing is, in the US, and this is unique to the US, higher rates are not hurting the majority of people. If you look at mortgage payments as a percentage of disposable income, they are lower today than they were in January 2020, even with 500 basis points of rate hikes, because during the pandemic, people refied, they locked in for 30 years, and so as rates have gone up, mortgage payments haven't changed. That's not true in Europe, that's not true in the UK, that's not true in Canada or Australia, where you have variable rate mortgages or short-term fixed rate mortgages. There you're seeing the recession come through. Eurozone is virtually in recession. The UK is virtually in recession. It's very close. Here it's taking longer because you have around 90% of mortgages are 30-year fixed. It's not hurting most people.
So let's bring it all back to the markets, everything you've been saying. You've mentioned valuations a couple of times. If I'm an investor, do I avoid stocks here? Do I get in here? Where's the S&P 500 going to go in the next 6 months?
Look, I have a reputation for being a bit bearish. I mean, I'm English, I'm an economist, I live in Boston. I mean, I'd be wary at these levels. I'll be absolutely honest. I'm wary at these levels. I think the market is priced for, as you say, this growth recession or this soft landing. That's the narrative now. That's what the market's priced for. And at the same time, we're pricing in 125 basis points of cuts next year. Well, why are the Fed going to be cutting so aggressively unless we're in a recession? The two don't add up. The bond market is saying one thing and the interest rate market is saying one thing. The equity market is saying another. And this is where I think that I worry about equity valuations. I think we have this sort of perfection. The AI boom sort of dragged everything up, and now we've got the sort of signs of inflation coming down or slowing more. And all of that is sort of fueling this narrative. It makes me nervous. It makes me nervous from here. Look, I think during the next few weeks in the earnings season, we're probably going to see more gains. Beyond that, I do start to worry.
Lee, it has been so much fun to talk to you. Even with the bearishness and the Bostonness and the English, all of that has been a pleasure. Lee Farage, thank you so much. Really appreciate it.
Thank you very much for having me.
Lee is head of macro strategy of North America at State Street. Well, while we were digging into that bearishness, we had the opening bell on Wall Street. So let's do a quick check of the market sponsored by Tasty Treat. All three major averages are in the green today, perhaps helped by some of those positive earnings announcements that we got and the increases in forecasts here. So we are seeing the Nasdaq lead gains. Also could be a little bit of follow through from yesterday and that cooler than estimated inflation report. The Nasdaq up 0.9%, the S&P up 0.5%, and the Dow is gaining about 106 points or a third of 1%. Brad has hopped on over to the Wi-Fi Interactive. What's going on? What are you seeing?
Taking a look at the Dow, as you were mentioning a moment ago, that's up by about 0.3%. Nasdaq Composite up by about 0.9%. Let's show people some charts. That's what they came to the Wi-Fi Interactive for, at least came to the screen to watch the Wi-Fi Interactive on a different screen. Anyway, taking a look at the 4-day move here for the Nasdaq, you're seeing that up over the past 4 days by about 2.8%, 0.9% in gains here on the day. And I mentioned the S&P 500. You're seeing that over the past 4 days. Hold on to gains of about 2.2% here today, up 0.5%, as you were mentioning a moment ago, Julie. Since we mentioned the S&P 500, yeah, you guessed it, 11 sectors in the S&P 500. We've got them loaded up for you here on screen. We are mixed as of right now, but really just two decliners, two laggards, if you will, and energy decided to throw itself into the fray there, at least for a hot second, just to throw off my groove. But anyway, XLRE bringing up the caboose. That's down 0.2%. XLY, do they have an alibi? Yeah, they do right now. It's up by about 1% for consumer discretionary. And then taking a look at XLC, you've got communication services and technology also leading the pack here, rounding out that top 3 spot. And then also, speaking of technology, let's take a look at some of those mega cap tech stocks. Seeing some significant gains on Alphabet on the day. That's up by about 2% to start off the trading session. Amazon also up by about 2.6%. Is Prime Days over? Is it done yet?
It's done, and they actually gave some numbers. They said they had record Prime Day sales on the first day of Prime Day.
Interesting. On the first day of Prime Day. All right, interesting. So Amazon, you're seeing that, those shares reflecting perhaps that announcement here on the day. That's up by about 2.7%.
And NVIDIA, our Jared Blickery just flagging,
Yep.
is at a record intraday high now.
Wow,
So up
let's put this on a
2%
long
the day.
term.
Let's do it.
Yeah.
So if you take a look at that longer term chart there, you see it. Oof.
I'll give you even more long term than that. 5 years? 5 years. You got it.
618%. Not too shabby. Thanks, Brad. Appreciate it. Your circle didn't work.
Hang on.
But I appreciated the
I'll be right back.
motion. Okay.
All right, cool,
Okay.
cool. Yeah,
You
there we
got
go.
it. There we go.
There it is right there.
Thanks so much, Brad. All right, we got much more circling and markets action coming up ahead. You're watching Yahoo Finance.
Is the worst of inflation behind us?
It is, especially after this morning. We're now down at 3% on the headline. 12 months ago, we were at 9.1% year over year. So I certainly think the worst of inflation is behind us. We're seeing signs that even going forward, inflation is going to continue to trend lower. You're seeing shelter finally come off the boil. You're seeing used and new car prices finally come off the boil as well. Core goods remains in sort of flat to potentially in a deflationary territory. So I think we're seeing all good signs here that the worst is behind us.
Let's take a look at some movers here as we get underway on this trading day. SoFi shares sinking after Morgan Stanley downgraded the stock to underweight. Our Ali Canal is back with the details on this call here. SoFi has really been volatile this year because of the overhang from the student debt case and what was going to happen with that. So this is just kind of the latest to cause it to whipsaw around.
Yeah, latest to whipsaw around. As you saw on your screen, it's down more than 4% on that opening trade. As you mentioned, though, Morgan Stanley is slashing its rating on the stock to underweight from equal weight. Analysts did raise their price target very slightly to $7 a share, up from the prior $6.50. Still, though, guys, that suggests more than 20% downside based on current levels. Morgan Stanley writing in a note, SoFi looks, quote, increasingly like a bank and therefore needs to be valued more like a bank. And if you do that, SoFi is currently trading about 2.1 times the projected tangible book value per share for 2024 based on those current levels right now. That implies a return on tangible common equity of over 30% in the near future. And that's something that Morgan Stanley says is just overly optimistic. Analysts also said the opportunity from the student loan restart is smaller than anticipated. SoFi has a current projection of over $200 billion. Morgan Stanley says it's about half of that. And that's something Wedbush actually called out as well in a note earlier this week. They said the refi opportunity is, quote, significantly smaller than that projection, in addition to the fact that SoFi student loans are less profitable than their personal loans. And that could create some balance sheet issues along with some profitability concerns as well. So a few problems at this company, but Julie, you were calling out that volatility. In the long term, SoFi shares are up more than 90% on the year since the start of the year, 50% compared to 2022. So it's a stock that long term has long been viewed as positive and has this successful growth story, but there are a few overhang issues, like you were mentioning, that are just adding to a lot of pessimism on the street right now.
Yeah, and the valuation doesn't help. All right, thanks, Allie. Appreciate it. Well, news that broke just about a half hour ago, the FDA has approved an over-the-counter birth control pill for sale in the United States. This is the first time. It's called O-Pill. It's manufactured by Dublin-based Perrigo. The company says it will likely become available in the U.S. by early 2024. So again, this is the first daily U.S. contraceptive, oral contraceptive approved for sale in the United States. So it's a big deal, right? 4.5% is the gain that we're seeing in those Perrigo shares right now.
Yeah, I'm looking through this release by the FDA, and they're saying that today's approval marks the first time, as you were mentioning, a non-prescription daily oral contraceptive will be available, an available option for millions of people in the United States. That coming from the director of the FDA's Center for Drug Evaluation and Research, and they're saying that when used as directed, the daily oral contraception is safe and expected to be more effective than currently non-prescription contraceptive methods in preventing unintended pregnancies as well.
So this pill was available with a prescription since 1973.
Wow.
And it took this long for it to be available over the counter, something that reproductive rights advocates have long been pushing for in at least 100 other countries. It is available without a prescription. So the U.S. is late in this regard, I think it's safe to say. O-Pill is what it's known as commercially. That's what it's been known as, I guess, with the prescription. Now it's going to be known that way over the counter as well. So we'll see what the pricing of this looks like. Reportedly, Perrigo said earlier this year that it does want to make this drug affordable. So we'll be focused on that once the pricing comes out, once we get more information on when it is going to be made available. But certainly a milestone here in the United States.
Yeah, and shares reacting as such. Let's also talk about shares of Carvana this morning. They are heading downhill after JP Morgan downgraded the stock to underweight from neutral, saying the company's valuations have disconnected materially from its fundamentals. You're taking a look at shares of Carvana down by about 4.5%. This has been an interesting kind of part of the market that we've been tracking, especially as economists have looked through some of the inflation data as well and looked back towards where the health of the consumer is and where some of the refinancing for even some of the car loans out there might roll over in this near term, whether they be new or used, and Carvana is certainly playing in that used vehicle landscape.
Yeah, Carvana has some specific issues as well, right, in terms of its balance sheet. This is a stock that going into today was up for 4 straight sessions and gained 60% in that period of time. It's up 720% on the year going into today's session. And so a lot of this has to do with valuation. The analysts here who making this call over at JP Morgan, Raja Gupta leading the team there, saying valuation has once again disconnected materially from fundamentals. Basically, it has gotten ahead of itself, according to these analysts. And the analysts say the company has made some progress here. They've cut down some costs. We've seen, yes, used car pricing has come down, but it has been, in the words of these analysts, resilient, and the company has slowed its cash burn. However, they still think they're going to need perhaps to raise some cash. The analysts saying Carvana should consider an equity raise here, and they should have considered it when we would see when the shares were lower than they are right now, about $10, $13 lower than where they are now.
Yeah, and tossing some spikes in the road with regard to the overall model that Carvana has as well, saying that we do not necessarily see the company's business model as highly superior or disruptive to the market at this state, despite having well-capitalized brick and mortar dealers. They also see that as those other brick and mortar dealers that are out there having the ability to find ways to grow, generate solid returns in an increasingly competitive environment. And so that for Carvana's business model, getting some cold water from JP Morgan here this morning, which was the Yahoo Finance 2022 worst performing company of the year last year. So we'll see if the bounce back continues for them.
Contrarian indicator, maybe.
Guys, all your markets action straight ahead. You're watching Yahoo Finance. What's the story that we're not talking about enough in 2023?
It's an interesting question. I do think maybe oil prices. We've now started to see a little bit of a stabilization, oil moving back above $75 a barrel. I will say I do think another move higher in oil prices is going to come from the supply side, not necessarily the demand side. Of course, China's recovery has been a little bit disappointing. Europe has now logged 2 consecutive quarters of negative GDP growth, so demand there could be a bit challenged. But we're seeing some resilience from OPEC Plus in terms of production cuts potentially going forward. And that could drive oil prices higher, potentially reverting some of the improvement that we've seen in the inflationary pressures, particularly on the energy side.
Disney's succession dilemma continues as CEO Bob Iger signs on for another 2 years at the helm of the media giant, extending his run through 2026. It's not the first time Iger has delayed succession plans, previously doing so several times during his first tenure. Iger said in a statement with the announcement that he wants to ensure Disney is, quote, strongly positioned, and added that the importance of the succession process cannot be overstated. Richard Greenfield, Lightshed media and technology analyst, is joining us on the phone now to discuss. Rich, it's always great to get your perspective on these issues. Iger also just gave an interview in which he talked about the non-core parts of the business, basically hinting that the linear television parts were not core parts of the business. As I saw one journalist put on Twitter, his initial tenure was about increasing the size of the company, more is more, and now maybe this is the less is more Bob Iger era. Do you think the company is going to sell off some of its TV networks?
Look, there's no doubt that the future of the linear broadcast and cable network business is challenged. I mean, you've got cord cutting is now at high single digit. Linear TV advertising's in secular decline. I mean, I think every legacy media company, I don't care whether you're Disney, Warner Brothers Discovery, if you're thinking about NBC Universal, part of Comcast, Paramount, every one of these companies needs to realize that the cable network business is in secular revenue decline. It is never getting better. And so they're in constant cost-cutting mode. You can spin them off. You can try to sell them. Maybe there's private equity that can sort of milk cash out of these things and lever them up until they die. But this is going to be a very challenged business. And I think Bob is I think what you basically heard from Iger this morning is there's no easy fix. That there is no magic. There's no pixie dust you can.
Oh, did we lose you, Rich? I think we've lost Rich, unfortunately. Really interesting, though, what he was saying, that basically you can't wave a magic wand and fix the situation with the secular decline in cable. So this is a real puzzle and conundrum for these companies.
Yeah, and a larger question, too, for Disney for the kicking of the can down the road continuously, or the kind of reemergence as Bob Iger as the sole figure that should be or could be the CEO time after time again. Does that create kind of a long-term question mark around, all right, what the succession plan actually could or should be, and what type of headwind that creates for shareholders even later on down the line? We're going to put a pin in that conversation, but switching gears here, Delta Airlines stock surging today as increased travel drove record high revenue and profit for the company. I spoke to Delta CEO Ed Bastian about the longevity of the travel surge, corporate travel, Sky Miles, and much, much more.
I think it's going to persist for quite some time. When we look at the health of our consumers, which is principally a premium consumer, we look at their top priority for spend is in premium travel experience. When you look at, on an economic level, the flip that we've seen where goods is overtaking services in our economy, and services are coming back, and actually the reductions in good purchases are funding that service spend returning. We think there's easily several years of this continuing, because the pandemic was a 3-year phenomenon. I expect on the other side of it, we're going to see just as long a recovery back to the norms where we were previously. And Brad, I'd say there's one other thing on top of that. We all look back to 19, but our economy is also over 20% larger than it was in 19 as well. So that's also helping fuel the larger gains that we're seeing.
Even within the several years out timeline that you're tracking, within kind of the rest of this year, how are even early September quarter bookings tracking against either year-over-year trends that we've seen, or even some of the higher pre-pandemic comps?
What we see in our fall bookings is really more of the same that we've been seeing all year. Our international bookings and demand look really strong. We do see seasonality returning post-Labor Day, as we would typically see, with some of the domestic travel behaviors changing a bit as schools reopen. But we also know hybrid work has changed how people travel, and I think that's offsetting any kind of reduction that we might see with back to school. And corporate travel is still below where we were previously, but we think there's going to continue to be a slow but steady improvement as companies continue to encourage a return to office environment. So I think we're looking at a very, very strong Q3 as indicated by our guidance, and I think we'll have a strong Q4 as well.
Do you believe that corporate travel will ever get back to some of its pre-pandemic levels, and does it need to?
I don't think it needs to. Candidly, one of the reasons why corporates are not all the way back are people aren't in the office and people are out traveling on their own through hybrid activities. So in a certain sort of way, I think we're actually seeing the travelers, potentially even greater travel, coming out of corporate space as compared to our normal pre-pandemic behaviors.
We've been tracking coverage from retail analysts who believe that the resumption of student loan payments would dampen spending towards goods. Is there any anticipation that some of that reallocated spending would also impact services and thus also impact Delta's business?
I don't think so. We see no indication of that. Again, Brad, our consumer is a premium consumer, largely. We showed a slide at our recent Investor Day where 75% of our industry's revenues come from households with net worth of $100,000 of income or greater on a per annum basis. That cohort that represents the bulk of our revenue base accumulated over $27 trillion of wealth just since 2019. So our consumers have the means, they have the interest, and we're doing the very best job to provide them a reliable service so we can get them to where they need to be.
Just kind of a follow-up. I was looking at that Sky Miles number and the growth that you're seeing there. When you think about those households and what the typical makeup income-wise is of those households, is that more millennial-driven? What type of kind of customer acquisition are you seeing in terms of the Sky Miles add-ons and the generation of new demand for customers that are entering into that particular part of the membership?
One thing that we have done, as I think you know, is we've introduced this year free Wi-Fi. And all you need to do is be a member in order to get free Wi-Fi on the planes. And we have seen a significant pop in our membership ranks, principally coming from younger consumers. The individuals that we are signing on the planes themselves, as well as people signing up before the plane trip, is on average 10 years younger than the previous age of our pre-existing Sky Miles customer mix. Prior to going free, our Sky Miles average age was around 40, and we're finding the average age of our new customers signing up to be approximately 30. So we're creating product and value that they want. We know that demographic values experience, and with the great service Delta people are providing, we're building a new generational loyalty.
And our thanks to Delta CEO Ed Bastian for taking some time here with us post Q2 earnings. We've got all your markets action straight ahead. You're watching Yahoo Finance.
It's going to be a moderation in earnings as the economy slows down, but I think what investors are going to find is that it's not the significant contraction in earnings that many feared.
It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. We're about 30 minutes into the start of today's trading activity. Let's take a look at how stocks are moving right now. The S&P 500 moving higher today as fresh inflation data and earnings boost stocks. Producer prices came in cooler than expected, another boon to investors following Wednesday's CPI print. Meanwhile, impressive results and positive outlooks from Delta and Pepsi, they put consumers in a positive light.
And speaking of Pepsi, shares of the beverage and snack company jumping today after reporting second quarter earnings. The company's net sales rose over 10% and it raised its full year guidance. The shares earlier were up more. Now they're only up about 0.4%. The food and beverage giant was not able to escape the impact of price hikes, though. Overall volume in its food and beverage divisions did take a hit.
We're also watching shares of ConAgra. They are slipping today after giving a downbeat forecast for the rest of the year. Well, shares are flat right now. Consumer staples brand saw sales jump nearly 10% in the fourth quarter, but volume declined over 7%.
And let's take a look at Carvana stock. Those shares are down by 4% after JP Morgan turned bearish. The analysts downgrading the stock to underweight from neutral, saying the company's valuation has surged beyond a justifiable level. Carvana has rallied so far year to date, partially thanks to a short squeeze earlier in the year. Well, Disney's succession dilemma continues as CEO Bob Iger signs on for another 2 years at the helm of the media giant, extending his run through 2026. It's not the first time that Iger has delayed succession plans, previously doing so several times during his first tenure. Iger said in a statement with the announcement that he wants to ensure Disney is, quote, strongly positioned, and added that the importance of the succession process cannot be overstated. Rich Greenfield, Lightshed media and technology analyst, joins us now to discuss. And Rich, want to pick up the discussion on this idea that the cable business has changed profoundly, and Disney and its competitors, for that matter, are going to have to adapt to that. What can they do? What can Disney do?
Look, I think Disney's got to figure out what it's going to look like. I mean, every media company is facing cord cutting, shifts of television advertising to connected TVs and other platforms. The linear TV business is just under a lot of pressure. And, you know, investors are already asking me this morning, well, who are they selling it to? Like, who wants to buy a linear TV business? That's what's really challenging. I mean, it's one thing to say you want to get rid of ABC or get rid of FX, but who exactly is the buyer of those businesses? I don't have a great answer for that.
Would any of the streamers buy a linear TV business and just take it online?
The problem is the streamers are replacing that linear TV business. They're buying, Amazon's buying the sports right. Like Thursday Night Football used to be on Fox. Now it's on Amazon. So they don't need to buy Fox. They just need to replace Fox. And I think that's the problem is who wants to buy a business that's in secular decline? That's not an easy thing. Like maybe there's a private equity firm that'll look at it as you've seen Apollo obviously step in and buy a lot of TV stations. And I think they've done great with their
We know something about that, Rich.
Hey, look, I just want to be honest. I don't think it was one thing to buy TV stations 3 and 4 years ago, even 5 or 6 years ago, as you saw a lot of consolidation in that space and a lot of cash pulled out of those businesses. Doing it in 2024 and beyond, I'll be honest, good luck.
Rich, what's the long-term overhang to the stock if Disney should not get its succession plans right or communicate that aptly to the street?
I mean, look, I think you have to look at Netflix, right? I mean, look at how Reed Hastings managed succession in the Netflix board. I think it's really disappointing that the Disney board just continues to flounder on succession. I mean, there should be a very clear set of succession, like who is number two. There should be a training process, like just like there is. And you saw what happened at Netflix as they groomed, the next wave of talent to take over for Reed. And Reed has really stepped back now, and you're seeing Greg Peters and Ted Sarandos take the limelight. I just don't understand why this is so hard for Disney. And I think it really makes you question, does the board need to change? Like, is this may be less of a Bob Iger problem and more of a Disney board problem.
Is that a bearish indicator for the stock?
Look, the bearish indicator for the stock right now is, other than theme parks, and even theme parks are softening, but every part of their business is facing real headwinds. And you heard Iger this morning say it is worse than he expected when he came back. And I think that's sort of the challenge that when Iger left in 2019 or 2020, but off of an incredible 2019, things were as good as they could get. The content was at an all-time high. Now the content cycle, I can't remember in my 30-year career covering Disney, I can't remember a time when the content was this, title after title is just not working. Like the content engine of Disney is sputtering. I don't know exactly why. We could debate lots of issues, but it is clearly not working. And the problem for Iger, and I think part of the reason he's staying, and this was our number one prediction for 2023, was that Iger would extend. And the reason or the rationale for that was turning the fortunes of content is not a quick fix. It takes time, years, to fix the content cycle. And this is going to be a long haul for Disney. It is not easy, and that's why the stock is under so much pressure.
So do you see anything else changing in the short to medium term, Rich? If that is a years-long process that the company has to go through, are there other things that Iger can do to improve the share price in the shorter term?
Well, obviously he's exploring strategic alternatives, but look, I'm not sure going out and spending $10, $11, $12 billion on Hulu, I don't think that's going to excite investors in the short term. Obviously, if they could find a strategic partner for ESPN, I think people would love to see ESPN sort of some other, some type of joint venture or something, because I think ESPN is seen as a very challenging business going forward. So, look, my major takeaway from the Iger interview this morning was he realizes they have a real problem across multiple businesses, and he's very open to exploring strategic opportunities for many of their businesses. And I think that's the major thing is we should be thinking about Disney is ready to change what it looks like in 2024 and beyond. And it may be a smaller company.
Just lastly, while we have you, we are keeping an eye on what Hollywood's first industry shutdown in over 60 years as the union representing 160,000 actors gets set for a strike. Richard, when you think about what this would mean for these media giants here, you alluded to it before, and we've even spoken with the chairman of UTA and the potential of that happening. Just the significance, but also what type of knock on production, as you had already mentioned, that the content engine is sputtering. How much more difficult would that make it in this near term for Disney to set itself up for that next leg of growth on a lack of content and the absence of some of the actors?
I'm actually a lot less worried about the lack of content because there's plenty of content these companies have created over the last year or two that they're going to roll out. What really worries me, honestly, is the part that nobody's talking about. Like, I'm listening to all of these discussions of the strike this morning, and what everyone is missing, the big thing that changes as of this morning when the strike goes into effect, talent can no longer market. So you won't see Tom Cruise promoting Mission Impossible. You won't see the Barbie movie talent promoting the movie anymore. All of that promotional with actors and actresses all over the world for these U.S. films, all of that stopped. And I think that promotional push, seeing them interviewed, seeing them talk about their films, being in the press, being visible, that sort of marketing benefit you get, I think that's a big loss for titles that are going to be coming out over the next few months while the strike goes on. Sure, production schedules will get delayed and disrupted when things were supposed to come out in 24, but the near-term impact is not being able to market right now. That's a big problem for these studios, and nobody is talking about that risk right now.
Yeah, I think Barbie will be okay at this point, but probably some of those others, to your point, that are coming out in the next few months. Finally, I want to ask you about what Iger said about the strike. This is the guy who's supposed to be on the side of the creators, right? He is supposed to be the creator's friend. And yet, what he said about the writer's strike did not sound so friendly to me when he talked about that the writers and actors in these unions are not being realistic. What do you make of those comments?
Look, the industry is changing. Everybody knows it. We're doing this online, right? This is a streaming broadcast, right? There is no doubt that the industry of how content reaches the consumer is changing, and talent and how talent is compensated needs to change. But the reality is, fighting the technology shifts, fighting things like AI, fighting streaming. Like, everyone knows that the compensation needs to alter, but there's also this. We're also in a phase of contraction where all of these media companies spend too much on content, and they're starting to slow their amount of production. They're firing a lot of people. We just talked about all the headwinds Disney's facing. The reality is paying talent meaningfully more, whether it's writers or actors, not so easy to do. And even the formulas, like, a movie comes out, there's a clear box office. What is a movie? How do you get how do you get a streaming bonus on a Netflix movie or a streaming bonus on a Disney Plus movie? Like, what do you base that on? Number of subscribers it brings on, how many subscribers don't churn, like the price increases that you're able to do a year later because that content was good. The value of an individual piece of content in streaming is much harder to delineate than it was in the old world, where you had things like ratings, like overnight ratings or box office specific numbers for that title. It's much harder when you're part of a subscription service.
Yeah, no, that's a key reminder here, and something that certainly is brewing in terms of the conversation. Actually, it's on the front burner right now. Richard, great to have you with us. Thanks so much for taking the time today.
Thank you.
All right. And switching gears here, Wednesday's Consumer Price Index report saw prices for food rise at a more moderate pace. That was up 0.1% on a monthly basis, 5.7% year over year, and falling in key categories. These price changes could start to have an impact on retail. Joining us now, we've got Yahoo Finance reporter Josh Schaefer. So Josh, what do these falling prices mean for retail stocks?
Yeah, Brad, so when you see those prices start to come down, right, you wonder what those high prices have been doing for stocks and doing for retail. When we're talking retail here, we're obviously talking broad retail. We're talking groceries. We're talking the retail companies that we cover that have groceries and then have other products, maybe Walmart, Target. So I was at a Goldman Sachs media roundtable yesterday, attended virtually right after this report came out, and we asked about lowering inflation and sort of what that means for stocks. And the overall consensus was, well, it's really not great for grocers because of how much high prices have led to ticket growth. What they're seeing right now in grocery stores, what grocers are seeing is a lot of the growth that they've had on the top line, a lot of that revenue growth has basically just been from inflation. It's really just been inflation fueled. So then when inflation comes down and the prices stop increasing, you need people to buy more products. People have been buying less products. And then when you expand that question out further, the question becomes, well, what if people don't buy more products at the grocery store? They probably have more money, right? Because they stopped spending so much money at the grocery store. And I thought it was interesting. Kate McShane over at Goldman Sachs highlighted this could be good for Target. She said specifically when you look at a company like Target that has a lot of discretionary spending, said that discretionary spending was slowing, and they also have food in their store, maybe if people are spending less money on food, it's a positive for Target because people now have more money to go spend on other things, i.e. discretionary spending, and that's where Target needs some help right now. So I thought that was sort of an interesting point when you think about what it means for grocers, but then also some of the other retail names that sell groceries, but maybe it's not their whole business.
Yeah, that's interesting. I mean, one of the other strange sort of knock-on effects is that if people are trading down to store brands are higher margin for the grocers. So then if they go back to the name brands from the store brands, the margins on those are a little less for those guys.
Right, Walmart's had success with that, right? And then she also, McShane made the same point about Target when you think about the products outside of food. It's a higher margin product for them to sell you a t-shirt, right? Rather than sell you food. So if people have been going to Target to buy some food, they'd actually rather sell you a shirt, or they'd rather sell you maybe a piece of technology or something else that's higher margin.
Where else will I get that Pizza Planet shirt that I've always wanted to get?
I actually just bought some bathing suits for my kids at Target.
They're good.
Yeah.
Target has good bathing suits.
It's
The
true.
secret's out on Target bathing suits. Has been.
I guess so.
Yeah.
Josh Schaefer, thank you so much
Colors,
for the
too.
information on groceries and Target bathing suits. I appreciate it.
That's what we're here for.
We got another positive inflation print this morning. The producer price index rising less than expected, up 0.1% from May, while the street expected twice that. This, of course, after CPI came in at its lowest level since March of 2021, boosting investor hopes the Federal Reserve is near, finally, the end of its rate hiking cycle. Joining us now is Greg Dacco, EY chief economist. Greg, it's great to see you. When it comes to moderating inflation, as you wrote in reaction to this report, maybe the free lunch, though, is over. Maybe the low-hanging fruit is over. In other words, maybe the stuff that was inevitably going to come down for various reasons, is that done? Is it going to be harder from here to see those numbers move?
I think to some extent, but we have to be encouraged by the fact that inflation has fallen quite a bit. We have consumer price inflation now that has a 2% handle. It was 2.97 if you look at the second decimal yesterday, so that's a very good print. core inflation still showing a little bit more persistence, but also falling to 4.8%. And as you mentioned, you're seeing that producer price inflation is also falling rapidly. PPI inflation is barely above zero at 0.1%. So these are very soft numbers and an indication that the disinflationary momentum is continuing. I think the free lunch in terms of falling energy prices, cooling food inflation, cooling goods price inflation is now largely over. So what we'll need to see further easing of inflation is core services price momentum continuing to ease. 0.2% on a month-over-month basis or 0.1% would even be better to see that ongoing disinflationary current as we move through the rest of the year and into 2024.
Within the services part of that equation, where do you believe some of the early kind of showings of that inflation easing might be?
Well, I guess the elephant in the room is certainly shelter costs, right? We had seen shelter costs rising at a very rapid clip on a month-over-month basis, 1%, 0.9% on a month-over-month basis for a long period of time. Now those increases have started to moderate. We're seeing shelter costs rising around 0.4 to 0.5% on a month-over-month basis. And we started to see that housing cost inflation starting to turn. That will accelerate in the coming months because we've seen in real-time data some further easing of rent prices as well as owner's equivalent prices. So that will ease the pressure. The other area where I think we will see some further easing of inflationary pressures, especially once we're past the summer, is the leisure sector. Airfares, hotel prices, car rentals, those are segments where we're likely to see on the services side some moderation in inflationary pressures. And those will, again, be a positive contributor to getting inflation back towards that 2% target, which the Fed is now hopeful it can do without necessarily breaking the economy.
Yeah, this is really interesting. We earlier were talking to Lee Farage of State Street, who questioned the idea that while we're going to see inflation come down, it's going to be difficult to get it back down to 2% without the economy weakening more significantly. What do you think?
I think we will see an overshoot likely on the headline inflation front. We're likely to see a bumpy summer. The base effect will play to some degree to the upside over the course of July and August in terms of headline CPI inflation, probably also on the core CPI front. But then once we're into September, October, November, and December, we're going to see the effects of an economy that has already cooled, where consumer spending is slower. It's still positive, but modestly slower, where business investment activity is also slower, and that will put downward pressure on inflationary dynamics. If you look outside of consumer prices, you look at wholesale prices, trade margins, which are a good indicator of how much there is passing on happening in terms of the pricing dynamics. If you look at import prices, if you look even at wage growth, all of those indicators are pointing towards easier inflation, cooling inflation, and more disinflationary pressures coming through. And even on the small business front, yes, there is nostalgia from an era where you could pass on higher prices, but that is a thing of the past. Now we're in an environment where it's much more difficult for companies to pass on their price increases, their cost increases, and that is feeding this disinflationary pressure that we continue to see.
I mean, it's very recent nostalgia because they were doing it as recently as a quarter ago. But what is your current thinking then on hard versus soft landing? Has the recent data changed your view at all about what the U.S. recession is going to look like and when it's going to arrive?
I think there is no doubt that there is currently a wind of optimism coming from the U.S. economy. The labor market resilience, the rebound in some supply categories, whether it's construction activity, manufacturing activity, or even the labor market. Those are encouraging developments on the supply side. And as we look into the next year, the next 18 months in terms of economic activity, I think it's still a coin toss as to whether the economy will end up in a recession or not. There is hope of an immaculate soft landing where the Fed perhaps does not need to tighten monetary policy as much as it previously thought. Our own view is that essentially after this July rate hike, the Fed will be done with its historic tightening cycle, will hold the policy rate constant until early 2024. And at that time, we'll start to recalibrate policy to the downside very gradually, but to do so in order to maintain the real rates constant in an environment where inflation has moderated. So my baseline view is that we have an environment in which growth does slow, but is still positive, where you see some increase in the unemployment rate, but not the type of retrenchment that we've seen in the past with massive layoffs.
Is that the definition of a growth recession? I'm still trying to wrap my head around this, quite honestly, Greg. I don't know if you heard our conversation earlier with Lee Farage, but we heard yesterday the term growth recession, and it was one of the first times I had heard it. So perhaps what you're describing is that exact scenario.
Yes, it's an environment where you have still positive growth, but an increase in the unemployment rate, perhaps towards 4% or a little bit higher than that. That is the best case type of scenario where you have this ongoing moderation of economic activity, inflation that comes back down towards a 2% target, the Fed that can hold off on further tightening monetary policy. It's a slow recession, a growth recession, however you want to call it, but that's the type of baseline scenario I'm thinking of. I am, though, very conscious of the fact that nonlinearities can really throw a wrench in this type of perspective. You can have an environment where suddenly something unforeseen precipitates financial conditions tightening, credit conditions tightening, and that leads to a more severe pullback in consumer spending activity, in business investment, and very importantly, in the backbone of the economy, in the labor market, which we have not seen yet, but it's still a risk that we have to monitor closely.
Yeah, we've gotten used to a lot of nonlinear, I like that euphemism, nonlinear things happening over the past few years. Things that came out of left field. Greg Zacko, EY Chief Economist, good to see you.
Great to see you.
All your markets action straight ahead. You're watching Yahoo Finance.
Have you tried Threads yet?
I have not. I did get the notification that I celebrated 11 years on Twitter though the other day.
Really?
So I feel like I'm kind of wedded to Twitter. But
you spent a lot of time building up that profile.
Yes,
and it's
yes.
good content too for our viewers out there.
So I have not jumped on Threads yet, but I am getting some pressure too.
Okay.
Let's do a quick check of the market sponsored by Tasty Trade. We are seeing all three major averages rally here once again today. The Nasdaq leading the way as we see records for stocks like Nvidia and strength in other large cap technology.
Well, the U.S. dollar fell to a more than one-year low on softer than expected inflation data. Well, what's next? Yahoo Finance's Inez Ferre joins us now with more. Hey, Inez.
Yeah, Brad, yesterday we saw the dollar really tanking after that CPI print. That CPI print sort of cemented this downward trend that we've been watching with the U.S. dollar. This is a 3-day chart that I have on the Wi-Fi interactive board. And you can see the big drop that we saw yesterday after that CPI print came out. Well, traders are now pricing in an end to the Fed rate hikes. Even if the Fed hikes 2 more times, it's unlikely that the dollar would go back significantly for the time being. The dollar, remember that it peaked back in September of 2022. It reached 114. Now, where does the dollar go from here if, in fact, it is on a downward trend? Well, some analysts are saying that it should stabilize if there is a soft landing. It could head lower if a recession hits. But what's important is what the impact of the softer dollar on equities. Remember that last year when you saw the dollar spiking, you saw equities coming down. And with respect to commodities, well, usually when the dollar goes down, commodities rise. So you can expect oil prices to be buoyed because of this softer dollar, commodities which are priced in U.S. dollars, guys.
Inez, speaking of oil, we're watching a story in the energy space today. ExxonMobil reportedly considering, or actually buying, oil and gas producer Denbury. So what else do we know there? Interestingly, we haven't seen that much of a increase in Denbury, but what Denbury really does here is carbon capture, right? It has CO2 pipelines in the U.S.
Yeah, that's right. Its biggest asset is that CO2 pipeline network that runs through Louisiana, through Mississippi, through Texas. And these are big areas with a lot of industry, a lot of big polluters. So you put that carbon into these pipelines. And in the past, Danbury has used that CO2 to recover more oil. Now they can store that CO2 underground safely, permanently, reducing emissions from the atmosphere. It's a logical acquisition, really, if you think about it, for ExxonMobil to go this route in order to be reducing carbon emissions. And this is a big turnaround for this company because you mentioned that the stock price hasn't really, it's down slightly. Well, this is a company with a $4.4 billion market cap. The deal would be for Exxon to buy Denbury for $89.45 per share. So you can see there that right now it's trading at around $87 per share. But also, this is a company that had gone bankrupt at one point. It exited bankruptcy. It went bankrupt when oil prices really plunged at the beginning of the pandemic. Since then, its stock price has gone up 4-fold. So the stock price completely skyrocketing over the last, look at this, 3 years, up 381%. And what's interesting about this deal also is that the Inflation Act of last year, that law that went into effect, that has created tax incentives for companies to capture CO2 emissions, to store them underground, and to not pollute the atmosphere.
Yeah, really interesting move here, and we'll continue to watch Exxon's moves on that front. Thanks, Inez.
Yep.
Citi, JP Morgan, Wells Fargo, they're all kicking off earnings season for the big banks tomorrow. There is a fair bit of caution following the sector after the earlier turmoil this year, but some are feeling bullish. Jefferies analysts upped their rating on JP Morgan recently to buy from hold, citing the bank's stable outlook. Joining us now is Gillian Tett, chair of the Financial Times editorial board and U.S. editor at large. It's great to see you. It seems like a lot of the focus is going to be on expenses for these banks, right? Current expenses and future expenses as well, both from regulation and what's been happening with rates.
Absolutely. Well, I mean, several reasons. Firstly, the banks are facing a very uncertain regulatory climate. That obviously benefits the big banks over the small banks because they have more money to throw at the problem. But that will be another issue that people are looking at. At the same time, though, they're also looking at questions about, what is the future of financial services and banking, and how much real estate do they really need, all those bank branches? which leads to the other big themes that investors are going to be looking at when it comes to the bank earnings. Firstly, what do they reveal about corporate real estate exposures? We've had lots of warning from people like Jay Powell from the Fed about the level of potential pain being felt in the commercial real estate sector. So what everyone's asking is, how bad will that get? Which banks will be hit or not? And then last but not least, the baffling question of consumers. What on earth is happening to consumers in America, given that on the one hand, their fundamentals are remaining surprisingly strong, and they're still spending, it seems, to a degree, albeit slowing down, but they keep telling all the surveys and polls that they are incredibly gloomy. So a lot to look for in the bank earnings.
To what extent do you believe that deposits will be a lingering theme this bank earnings season?
They certainly will be a lingering theme because, of course, the shadow of Silicon Valley Bank and the shock of seeing how quickly those deposits flooded out is something that nobody is going to forget quickly. And the reality is that in spite of all the Fed's reports and people like Michael Barr, who's been, did that big report for the Fed, the reality is we still haven't really seen a particularly convincing fix to these problems in terms of preventing these dramatic outflows if investors start to lose confidence in any particular banks. Now, the good news is that there's no sign they're losing confidence in the big banks, and there hasn't really been a sort of panic attack in the regional banking system since we had that SVB crisis. But of course, if things do start to turn nasty, if we do start to see commercial real estate loans creating real problems for smaller and regional banks, the question about whether it's time to overhaul the federal deposit insurance scheme or not is going to come up back on the agenda, and you're going to see more questions looking at deposits. And of course, the other question is that as banks are under pressure to raise the rate of return they give to investors or depositors leaving their money with them, we're going to see which of the banks can actually cope with that kind of squeeze or not.
Talking of another kind of bank, Goldman Sachs, there's been some reporting that the company is sort of quietly trying to downplay expectations, which is different for Goldman. I just wonder what you make of that and what that tells us, not just about that bank, but about the bigger environment. Or maybe it's just about Goldman. I don't know.
Well, it's very interesting. I mean, Goldman doesn't report until next week after JP Morgan and Wells Fargo and Citi and groups like that. And in the past, it's been vociferously opposed to the idea of trying to guide earnings. This time, for the first time, it is trying to guide earnings down. That may be because it's simply trying a new tactic in terms of its investor relations, but it may also be that Goldman has got more bad news to share, whether that's on the commercial real estate side or whether that's on some of the potentially hung bridges that it's been involved in, or maybe it's back to the issue about Marcus again. There's considerable concern about its adventures in the retail banking sphere and why those have gone badly. So we simply don't know yet why Goldman has changed its tactic and its tune, but it's certainly something that's causing quite a buzz on the street right now.
Is it all possible, or is there a pathway towards us getting past even the falling action of the banking turmoil without there being a commercial real estate crisis?
Well, the commercial real estate issue is very, very interesting indeed, because if you look at the macro aggregate data, it's pretty nasty. I mean, you've had interest rates now jump up 500 basis points in the last 18 months. You've got about 250 plus billion worth of commercial real estate loans that are due to mature this year. And if you look across the next 3 years, it's about 1.5 trillion. So that's going to really hurt. And you've also got office occupancy collapsing. I mean, McKinsey's out with a big report this morning, which suggests that between now and, say, 2030, you're going to see a permanent decline in office usage by about 20% in a benign scenario. If it's a bad scenario, it could be 38% economic scenario. So there's a lot of pain there. But the critical thing that I think investors need to understand is that those aggregate numbers conceal a huge variation, not just between cities. I mean, Houston is pretty different from San Francisco right now, and not just between city districts. I mean, what's happening in the East Village in New York and what's happening on Wall Street is quite different, but also between different buildings. And you're seeing a real split between the good buildings that are green, digitally connected, and suited for hybrid working, who's for the most part are seeing rents increase and the values increase, and the legacy buildings, what the industry calls Class B and Class C, that are really, really suffering right now. So the question that hangs over the bank earnings is what kind of commercial real estate loans exactly are they exposed to? We don't always know. And then the other really big question politically is, can the city leaders in places like Manhattan or San Francisco get their act together and change zoning laws to ensure that these buildings can be rapidly reconverted away from office buildings that are losing their values into the kind of buildings that people actually want, like cheap apartments for young professionals who still actually want to live in cities?
Yeah, well noted. Jillian, if you kept running through New York neighborhoods, I thought you were going to get to downtown Brooklyn in my neck of the woods at some point. Great to speak with you here this morning. Jillian Tett, chair of the Financial Times editorial board and U.S. editor at large. Thanks so much, Jillian.
Thank you.
All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. I guess the other pressure point out there that many athletes have been feeling recently is the pressure to try out pickleball. Have you tried out pickleball yet?
I have not tried out pickleball yet, no. But maybe it'll be something this week and I can have some fun with.
Okay, imminently trying out pickleball.
Yes.
I'll put you down for that. Jordan, thanks for the time.
Thanks so much.
A new report is raising concerns about the safety of forgotten telecom wires. A new study from the Wall Street Journal found over 2,000 lead-covered cables in the 5 most densely populated states across the U.S., some underwater and some aerial. One of the reporters behind the study, Thomas Greida, joins us now. Thomas, great reporting on this. Just help us break this down further. What did you guys uncover?
Thanks for having me on. Yeah, that's right. We uncovered sad that companies have left thousands of these cables around. They're coated in a thick sheath of lead as a protectant for them, and they are crossed. Often, many that we found were in waterways. So sort of left there. They won't get better over time. They sort of deteriorate, and our testing showed that they're actually leaching lead, which can be a problem for workers or just people who are recreating anywhere these things are located.
Thomas, I'm curious, as a fellow journalist, I'm always curious in the sort of procedural of all of this. Obviously, lead has been a problem in the U.S. for decades that we have made enormous strides to cleaning up. What led you guys to look into this in the first place?
Yeah, I was, I covered telecommunications for years on the corporate side and understood how the networks worked pretty well. And frankly, when I heard about lead, I was like, what? How's this is not lead in phones? But sure enough, like our research showed that this was something that was once the standard technology. And, as we searched, it was really a piece by piece. We would get one thing and we would go on to the next. We do some testing and really not expect to see anything and actually find things. And so we kept going, and we worked with a lot of experts that really guided what they were doing, what we were doing, and we were with them at all times. And it really was, we were really surprised as this was going along, what we found.
Are you finding that any of the companies that have left these cables behind are having any efforts to try and kind of course correct or just go get them back? Or I don't know what you do and how you go about reacquiring these things.
Yeah, so that's a good question. So there are ways to remove, especially aerial cable, where it's a little easier to take it down because it's, you can sort of secure the area and wind it back onto trucks. There are very complicated procedures that companies can follow, but of course this is not something that people have really looked at. And so I think the companies are very much sort of, saying they don't believe that it's a public health threat, and that they believe they're following the practices that they're supposed to be following. And the industry overall has signaled that they want to find a solution, or they want to work together to solve this problem, if it is in fact a problem in their eyes. According to what we found, there does seem to be a problem here, and the scope of it is not entirely clear.
Well, Thomas, I guess then the next step would be to figure out what the scope of the problem is, not just to figure out where these cables are, but to figure out if indeed they have had an effect, right? I mean, you did, the research that you had conducted did detect lead in soil samples, in water samples, et cetera. Is there then a move to test people who are around these sites, for example, to figure out if they have had lead exposure?
Yeah, so we actually did work with some people who had tests done, and we did in some areas find that there did appear to be higher exposure to lead. And that is obviously the concern is unleashing lead is relatively stable. It's when you disturb it that it can become a problem. And so if it is readily available and people are around it, that's obviously a concern.
Thomas, thank you so much for being here. Really great series, great work by the Wall Street Journal. Thomas Greta and his team over there. Encourage everyone to check it out. Thank you.
Thank you. Stay tuned.
Thanks. All your markets action coming up ahead. You're watching Yahoo Finance.
How would you describe the consumer right now?
I would say the consumer is bending but not yet breaking. When you think about the bend, certainly excess savings have been spent down pretty much when you look across all income quintiles. When you look at 401k hardship withdrawals, we're getting anecdotal evidence that some folks are tapping on those to potentially fuel some of their spending. But they're not necessarily breaking, right? They're still spending. If you were to look at, we talk about revolving credit debt in aggregate, and I know the number is a scary number, but if you look at it as a percentage of disposable income, it's actually below where we were prior to the financial crisis, and it's creeped up a little bit, but roughly where we were at just right before the pandemic. So I think we're seeing a normalization in credit usage, not necessarily consumers coming overextended. So I would say consumers are bending, but not yet breaking at the moment.
Professional cricket is coming to the United States. The inaugural match for Major League Cricket, it's set to air today. The league, which was initially meant to debut in 2021, was shut down due to the COVID pandemic. It's now coming back for its first season. Hosted out of stadiums in Texas and North Carolina, Major League Cricket will span 18 days, have 19 matches, and will show the best of the best from 6 different professional cricket teams. We're joined by someone who believes cricket will crack into the U.S. audience. That is Washington Freedom owner, that's one of the new teams, as well as founder and chairman of Infinite Computer Systems, Sanjay Govil. Thank you so much for being here, Sanjay. It's pretty cool. It's not every day that you see a new sport and a new professional league come to fruition. So how did this happen? How did the league come together? How did you get involved?
So obviously, first of all, thank you so much for having us and promoting cricket in the U.S. We are very excited. We have been at this for many, many years. U.S. does have a history of cricket. There used to be a Philadelphia Cricket Club in the 1800s when cricket was semi-popular in the U.S. And for the last 15, 20 years, there have been a lot of cities and leagues where cricket is actually played. And this was the time when we felt that we have an opportunity for a major league cricket league and to have the Washington Freedom team based right here in Washington, D.C.
And so when we think about the makeup of this league and what's going to make it successful, what does the first season, 2 seasons, what do you believe that has to hold? What does that have to entail in order for it to get off to a booming start?
I think awareness, being on Yahoo Finance today, that's one step towards that. There's already a lot of buzz which is being created. Most of our matches, if not all, are sold out. Considering the fact that, we only got going in terms of ticket sales about a month back. So there's a lot of excitement, a lot of buzz, and it's leading to numerous things. Next year, the World Cup is happening, the T20 World Cup. U.S. is one of the home grounds for that. And then 2028 Olympics, hopefully cricket will become part of that. So there's just a lot of excitement, and our goal is to create that buzz, create that, what people want, give a product, bring world-class stars, and also the most important thing is to promote U.S. cricket.
As we talked about, for now, the teams are going to be playing in just a couple of locations. If people are not there, how can they watch these cricket matches? How is the sort of airing rights worked out?
Sure. So in the U.S., we are telecasting on Willow TV and also on CBS. A few games are coming on CBS, and then we have media partners across the world. So we're going to have a substantial number of people watching. 2.5 billion people who watch cricket or big fans of cricket across the world. Second most popular sport in the world after soccer. So we see a huge opportunity. And we see a lot of passion already happening in terms of cricket.
So that's really interesting, Sanjay. So you're expecting not just to benefit from people who are cricket fans in the U.S., but globally who are interested in this league. Are you drawing on the people who are playing in these leagues? Are they also members of cricket teams across the globe?
Absolutely. I would say most of them have played or are playing for their countries today. And not only that, we have players who have played in the Indian Premier League and other leagues across the world. So these are really, really household names who we have here in the U.S. So we are very honored and privileged that in our very first year, we have the quality of players who have come. And we are really, really excited to see that. And the American audience is really, really excited to see those players play, because we've only seen them on TV or if we have gone to countries where they're playing. But now to have them come to the U.S. and play here is really a big thing for us.
Talk to us about the fan experience. I mean, when people go to a sporting event, they want to be close to the players. They want to have that access into them. They want to be able to watch them from wherever as well if they can't go to the match. So what does that fan experience look like?
That's a very good question. So we are actually building a stadium in George Mason University, and just to answer the previous question in terms of where they can watch, right now is Dallas and Morrisville, which is near Raleigh, but we are building stadiums across the country. DC is going to have a stadium in the George Mason University campus. George Mason is the biggest public university in Virginia, and the fan experience is going to be all around what we as Americans enjoy, which is, fast-paced, no more than 3 hours, go in there, have our hot dogs, hamburgers, beer, cheer the teams, have a good time, and family-oriented and kids-oriented. So that's the kind of experience we want to have around our matches.
I noticed that when I look at the owners here, and Satya Nadella of Microsoft is another, his team's called the Seattle Orcas. Cricket is huge in India, and obviously you guys are Indian Americans. How do you, and it so has a huge cultural importance there as well. How do you sort of broaden the appeal? I mean, you're talking about it in American terms. It has some of the, as a sport, it has the same appeal as a baseball or some other sports like that. So how do you sort of broaden that appeal?
We broaden them by making them more aware. I mean, whenever I talk to people who have grown up here, the good news is that they've all heard of cricket, which is great. And there's been a lot of cross connects between the U.S. and cricket-playing countries. There's a big immigrant population which has actually come here. Their children go to elementary schools, junior school, high schools, colleges, universities. They talk to their friends about cricket. So cricket is a known thing. The stigma which cricket had was, oh my God, it's 5 days long, blah, 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 blah. But there's a shorter version, which is the 3-hour version, which we are playing here now. So we just have to expand on that. Pickleball, for example, has really caught on just in a matter of 2 or 3 years. And we feel that we have a very good product, and we feel that, we can really expand the reach of what we have.
Wow, cricket, the next pickleball. We'll see. We'll see. I mean, that would be great for you guys. Pickleball has grown very quickly. Sanjay, what a pleasure to talk to you. Really fun stuff. And we'll be watching the matches. Washington Freedom owner, as well as Infinite Computer Systems founder and chairman, Sanjay Govil. Thank you.
Thank you so much. And thank you for your time and giving us this opportunity to promote cricket.
Of course. Take care. Rochelle Akufo's got you for the next hour. I wonder if she's a cricket fan. We'll have to ask her.
I just want to play now.
I know, right?
Sign me up for the Seattle Orcas. I'm sure it's a sign-up.
Done. Yeah, that's it. Take care, everybody.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. The FDA has officially given the green light to the first over-the-counter daily contraceptive pill in the United States. We'll discuss what this means in a post-Roe v. Wade world. And a slight tailwind for Delta shares this morning. This after posting record quarterly results. We'll get a vibe check from that earnings call. Plus, how Barbie buzz may be a net positive for retailers and which companies could be poised to benefit the most from this blockbuster. We've got that discussion coming up. But first, let's take a look at how the major indices are faring this morning. We see green across the board there, though they are trading in a narrow range. We see the Dow there just up barely. They're about 65 points or 0.2%. The S&P 500, they're up about 25 points or 0.6%. That's leading with communications in the sectors. And the tech-heavy Nasdaq, they're up over 1%. They're up about 140 points. Let's also check in on the Treasury market. As you know, investors have had a lot to digest with inflation data this week. We see the 5-year down about 1.7% there. The 10-year continuing to stay below that 4% mark there, down more than 1% as well. And the longest-term 30-year yield, that's down about 0.25% on the day. Well, today, the Food and Drug Administration approved the first ever over-the-counter birth control pill that can be taken daily. Now, consumers will be able to purchase Opill at pharmacies and drugstores without a prescription. That's a milestone in the fight for contraceptive access. The US joins over 100 other countries worldwide where birth control pills can be bought without a prescription. Kelly Blanchard, IBIS Reproductive Health President, joins us now for more on this. Good to have you on the show, Kelly. So talk about the significance of this approval.
It's just an amazing day. It's been a long journey to this moment. We know that in the United States, many people face barriers to accessing contraception under the current prescription requirement. And being able to access a safe and highly effective birth control pill directly off the shelf will be, we hope, just a transformative advance and allow people to, really make those decisions that they want to make about building their families, being able to implement what they want, what they dream for their families and their own well-being, their family's well-being.
And obviously, this is the first in this push. But what about other companies? Do we get some sort of reaction from Big Pharma as to how they're feeling about this, and perhaps what this opens up for them as well?
We really hope that this will be the beginning of additional products, additional hormonal methods of contraception becoming available over the counter. We know that there's at least one other birth control pill in the process. We've seen the American College of Obstetricians and Gynecologists proactively ask and support the idea that all hormonal methods could be available over the counter. So we're excited to see this approval today is really historic. The first ever approval of over-the-counter access to a daily, highly safe and effective birth control pill. But we hope this will be just the first step as we see this transformative approach to access take place for other methods as well.
And how soon do we know about its availability and any sort of pricing?
So according to Perrigo, the company that submitted this application, they hope to have Opill on the shelves early in 2024. And we are waiting. I know they have plans to announce the pricing in the coming months.
And in terms of any sort of side effects or people who shouldn't be taking this, what should people be aware of here?
This pill, Opill, is a progestin-only pill, and it is appropriate for virtually everyone to use. People who have or have a history of breast cancer should not use this pill, but otherwise it is safe and effective and absolutely appropriate for people of all ages to be able to use. And I also want to add that, one of the exciting things that our coalition, the Free the Pill Coalition, has been working towards is making sure that this switch is a different kind of switch and that it really centers the voices and leadership of people who really struggle to access contraception and healthcare in this country. And that means due to systemic inequalities, Black folks, Indigenous peoples, Asian American and Pacific Islanders, Latinx folks, young people, people working to make financial ends meet. And so we really hope that this is going to transform access for those folks who really face more barriers to access to contraception, and that this will help them have, again, a new way to access safe and highly effective methods.
Because I think sometimes people, when they see these decisions come down, they don't realize the economic impact when you do have more control over your family planning. What could this mean then to have, especially some of these disadvantaged groups who haven't had access to this, or perhaps just through expensive insurance that perhaps they couldn't afford? What does this mean in terms of sort of economic movement forward for some of these groups?
Well, I think first, most directly, we know that even having to get a prescription can be a financial hardship. You have to have a doctor, you might need time off work, you need childcare, you need to travel to get to your provider to pick up the medications. So over-the-counter access for some folks can help them overcome that very specific financial and time barrier to accessing contraception. And then we know from decades of research that people who have access to the tools to make decisions about when and how to build their families, that they are able to implement their decisions about increasing their own health and their family's health and well-being. And so access to contraception and access to reproductive health care more broadly is so critical for all of our health and well-being. And this will be, we hope, just another way to transform access that, as you say, really is accessible and makes a difference for folks who are struggling to access contraception right now.
And do we know in terms of any pushback that might affect the rollout of this pill, given that, you know, some religious groups, there was some pushback, obviously in the light of post-Roe versus Wade, a lot of people wondering, what does this mean now for the future of contraception in this country as well, thinking that would also be next here. What message do you think this sends?
Well, we know from our research at IBES, from other research from KFF and others, that there is really high levels of support among a whole range of folks for over-the-counter access to contraceptive methods. And we know that virtually everyone in this country, regardless of their religious affiliation, has experience with and supports access to contraception. And so I think there's just really strong support across the board here. And this has been a long process. Our coalition has been working for nearly 2 decades to make the case for this change. And it's just one piece of the broader effort needed to ensure that everybody has access to the full range of reproductive health care that they need. This certainly doesn't replace people's need for access to high quality abortion care, but we hope that it's one piece that enables people at least to better access the contraception that they need and want.
And we'll certainly continue to track that story. A big thank you there to Kelly Blanchard, president of IBES Reproductive Health. Thank you so much.
Thank you for having me.
Well, the resilient economy and consumer have unexpectedly thrived through the Fed's tightening campaign so far. Defying expectations, the S&P 500 and Nasdaq both enjoying the best start to the year in 4 decades. More than a year after warnings of recession, one has yet to materialize. Is the market out of the woods? Well, according to our next guest, that's the Fed's choice. So joining me now is David Waddell, Waddell Associates CEO and Chief Investment Strategist. Good to have you. So break down this base case that basically says if there is a recession at this point, that's the Fed's choice.
Yeah, not only that, I don't think it really matters. And here's why. If you go back over the last 6 quarters, the economy's been kind of crawling anyway at a less than 2% rate, more like a 1% rate. We got a little bit better news in the revisions for last quarter. This quarter, maybe tracking around 1%. What's kind of interesting about this time period to me is we've been in such an abnormal environment for the last 3 years. Now we're sort of rotating into a normal environment, and that's making people uncomfortable. So normal GDP growth should be about 2%. Normal inflation, if you go back over history, should be about 3%, which is where we are. Normal interest rates should be about 4%, which is where we are on the 10-year. So quite slowly, we're reclaiming normal sort of one statistic at a time. So it may be that the economy tips into recession. Obviously, the soft landing case is growing, but even if it does, that mild recession scenario, I think, still holds. And I don't think it really matters. Let's not forget, we went into a mild recession in the first 2 months of last year, and people sort of didn't even call it recession. So I think the Fed has done its job, and natural forces have also played a role in getting inflation down, and that just eliminates the need for them to really crash this economy. So I think we're fine. We're sort of reclaiming normal, and that's what's encouraging people so much, because the reality is starting to come in as we knew it, which is a good thing.
So, I mean, still widely expected to see the Fed hike rates in July. But at that point, do you think that's it? Is that going to be just sort of a holding pattern for a while and then cuts, or is this a pause and a hike?
So they need to save face. And they've done a pretty good job, really, of setting expectations in the market for what they're going to do. When you look at that CPI report that came in at 3%, if you take shelter out of it, which is 40%, that's owner equivalent rent and rent, that report was 1.7%. So that's year over year. That's not inflation. I mean, that's even below target. Even at the core, if you reduce it, it gets down low. So the PPI that we got this morning was below expectations. So the economy, good news, is surprising to the upside, while inflation, good news, is surprising to the downside. So it's happening. They don't need to press the brake any further, I don't think, unless they really do want to focus entirely on the labor market and deal with the supply and demand imbalances there. It's still a tight labor market, but inflation is meeting the mark. So they'll go one more time in July because they told us they would. But after that, I don't really see any reason to go further unless we get some sort of spike, some sort of upside surprise, which I don't see right now. I think this trend is intact. It's really market friendly. It's very economically friendly. And that's the reason why you're seeing the rally continue.
And David, obviously, we're going to be coming into the thick of Q2 earnings season here. So with that in mind, I mean, there was a low bar for earnings. I mean, but the same low bar was set in the first quarter. But you seem to be more optimistic about this. Why is that?
Well, here's the thing. So right now, the estimates are that we'll lose 7% in terms of year-over-year growth in earnings. By the way, that's against Q2 2022, which was the top in earnings. So the entire drawdown, and this is probably the nadir, or at least analysts seem to think so, this quarter was 7%. Okay, that's not that big a deal. The reason I'm optimistic is last quarter, there was an enormous earnings surprise. And in fact, going into this quarter, we've seen more upside guidance than on average. And places of the market where you'd expect to see terrible earnings like financials are actually projected to grow. So the market, I think, has determined that earnings will likely come in a little bit better than expected. And by the way, that's old news because we're forward looking. So if we get past this, the economy stays afoot, and corporations have done a great job preparing for the recession that hasn't come, which is very supportive for earnings. Now we're talking about next year's earnings at 250. The following year's earnings at 270, and we're at 225 today. So if you apply reasonable multiples to that, either on forward or trailing, you can make a case, I'm not making a prediction, but you can make a case that this market still got another 20% to run based upon what's reasonable as far as earnings expectations going forward. So I think this quarter, we've had 3 year-over-year negative quarters in a row. This might be the end of that. But I'm expecting, again, that it comes in better than expected, and companies have signaled that to date. So it'll be down, and that's a bummer, but all that matters is that it comes in above expectations, and I think it will.
All right, always great to get your insights. David Waddell there. Waddell Associates CEO and Chief Investment Strategist. Always good to see you. Take care.
Great to be with you. Thank you.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Is the worst of inflation behind us?
It is, especially after this morning. We're now down at 3% on the headline. 12 months ago, we were at 9.1% year over year. So I certainly think the worst of inflation is behind us. We're seeing signs that even going forward, inflation is going to continue to trend lower. You're seeing shelter finally come off the boil. You're seeing used and new car prices finally come off the boil as well. Core goods remains in sort of flat to potentially in a deflationary territory. So I think we're seeing all good signs here that the worst is behind us.
Let's do a check of the market sponsored by Tasty Trade. Still looking at positive territory, although some of that buying action slowing down a little. We're seeing the Dow there still up about 60 points or 0.2%. The S&P 500 there also up about 0.5%. We're seeing comms and tech leading there. And of course, that also means with tech leading in that sector, we're seeing the Nasdaq also lifted, although paying back a little bit here, but still up more than 125 points on the day, just shy of 1% so far. Well, Alphabet is rolling out new updates for its AI system, Bard. The tech company is expected to expand Bard's features, languages, and availability in several new countries. Let's bring in Yahoo Finance's Dan Howley to break it all down for us. Hey, Dan.
That's right. We're talking about Bard. This is the AI chatbot from Google, not to be confused with the search engine experiment that they're running, the search generative experience. That has generative AI built into it, but it's not Bard. So we're talking about the individual app here. And the app itself is now available in parts of Europe, Brazil. It's available in 40 languages, and they're adding new functionalities to it. So among them is the ability to upload images to Bard and then prompts as well to give you a response related to that image on its own. This is something that will allow for what's called a kind of multimodal response, where you'll get an image or you'll get a response in text. And that's kind of the way that these types of chatbots are really looking to move forward, or companies are looking to move these chatbots forward. We've also seen more movement in the AI space. Elon Musk obviously launching his own AI company with the kind of vagary of understanding the universe, not really sure what that means, but he's going to hold a Twitter Spaces on that. So we'll see. And then we also had earlier this week, Bill Gates released an op-ed about AI and kind of the fears that go along with this kind of technology, as well as the ways to mitigate those fears. So a lot still going on in this AI space. We had a lot of talk and discussion earlier in the year, continued up until the last few months. It's still ongoing to a great degree. And, this is Google really trying to fight back against OpenAI, as well as OpenAI backer Microsoft and its own Bing chatbot, saying, look, we have the capabilities to do this as well. They want to kind of reclaim the position as the top, dog as far as AI in Silicon Valley. And this is part of that effort.
And do you think realistically they're doing a good job at closing that gap, or is it still too early to tell as we continue to see, it seems like a new generative AI product or sort of improvement rolling out every day?
Yeah, I think it's still too early. This is, it's a secondary app. I think, when it comes to search, most people still use Google, right? And these kind of chatbots are meant for a multitude of things, but you would imagine that most people would use them to ask search-related questions. So I think, if and when Google eventually rolls out the search generative experience of its search engine that uses a chatbot or that generative AI technology, then I think we'll really start to see momentum from Google in that space. For now, it's a secondary app. It's not really related to the main search engine at all. Microsoft, meanwhile, has it built into the search engine as is. So, I think for Google to do that, they're going to have to ensure that they can roll it into the actual main Google search. There's a number of things that they have to get right there. Chief among them is the accuracy of the responses. People turn to Google search for very important things, whether that's related to their finances or their health. So you can't have this kind of the hallucinations that come along with this type of AI. I think the other issue, and this comes down to just the bare bones business of Google, is will they be able to show display ads at the top as they do now, right? At the top of Google search, you usually get ads. With that search generative experience, you don't see ads at the top. And that could ding Google's bottom line. And that's something that they're going to have to contend with, or at least maybe figure out where they would show ads alongside that to ensure that they can push that forward. So we still have to wait for all of that to kind of shake out likely before we really start to see Google gain that momentum back. But yeah, that's on the consumer side. On the back end, this is the company that basically helped create the transformer technology that is the T in ChatGPT. So they still know what they're doing, probably better than most people realize.
Well, we'll certainly be keeping track of all of that. Appreciate that update there for us, our very own Dan Howley. Well, to another type of investment now. Between Bill Maher's stake in the New York Mets, David Letterman's Rahal Letterman Lanigan Racing, and Ryan Reynolds co-owning Wrexham AFC, the wealthiest are turning to owning sports teams. And according to the Financial Times, bids for Manchester United by the Qatari royal family and British industrialist Jim Ratcliffe weren't high enough for the current owners, the US's Glazer family. Well, today, Knighthead Capital Management LLC, through its affiliate Shelby Companies Limited, has completed its transaction to purchase Birmingham City Football Club, acquiring full ownership and control of St Andrews Stadium and a 45% ownership of Birmingham City PLC. We're joined now by Knighthead Capital Management co-founder Thomas Wagner and our very own Ali Garfinkel to discuss this more. So a big welcome to you here, and congratulations on this acquisition here. A lot of people wondering, in terms of a football team as an asset in general, and specifically why Birmingham City Football Club. Walk us through that.
Sure. Well, first, thank you for having me and the opportunity to speak about this exciting investment that we've made. You know, I think for us, it relies on a number of things. One, we often focus on situations that are in need of capital or a turnaround. And this particular situation represents an incredible opportunity to make an investment in a storied franchise in England's second city. And it's a city that has a tremendous amount going for it. Birmingham is a young, vibrant, diverse city that is really on the rise. And we saw this as a way to help transform the franchise so that it really delivers for all of its various stakeholders, certainly the fans, the local community, and our commercial partners. So there's just a huge opportunity here to make this a commercial success and really to deliver something for the fans that has been missing for a long, long time.
Hi, Tom, Ali here, and welcome. Thank you so much for being here. So in terms of control, 45.64% stake, I believe. What level of control does that mean that Knighthead has over Birmingham City FC?
Sure. The way that the transaction has been structured, we will assume full operational control over the team from today forward. So we'll be setting the strategic vision for the club, and ultimately we'll be the ones who are responsible for achieving the goals that we set. So I think it's fair to say that the buck stops with us from here forward. We know that we have a lot to do, but we're really, really excited about the opportunity. And as I said, it's just a tremendous situation where we can draw in the fans, the community, our commercial stakeholders to really make this a collaborative success.
And digging into that collaborative aspect of it, obviously football at heart, it's local, you know, at the end of the day. So for fans who are wondering what this means in terms of the sort of say they have and what happens with the club going forward, as well as the fan experience, what would you like to share with them?
Sure. I think that every element of the fan experience needs to be improved upon. It's not simply, you know, the performance on the pitch or where we stand in the table. It's everything that the fan experiences from the moment that they first set eyes on the stadium, and St Andrews is a very, very special place, until the moment when they leave at the end of the match. Every minute of that experience has to be first rate. That's what our fans deserve. So everything that goes into that experience will be reimagined and reinvested in a way that hasn't been done for a long time. So we're excited to begin unveiling some of what we've been working on. It's been a very short period of time between when we entered into the transaction, and certainly from now when it closes until our first match just over 4 weeks from now. We've got a lot to do, but my teaser of a promise to the fans is that I think it will be largely an unrecognizable place from that first match forward, and we hope to only make things better as the season goes on, and then further investments as we have more time in subsequent seasons will only improve the experience.
You said something really interesting, Tom. You looked into this camera and you said the buck stopped with us from here on out, from this day. So what is kind of the current state of the club? What do you want to change?
Well, starting with where the state of the club is today, I would say we are very blessed with an incredibly energetic and loyal fan base. This is a group of people that have weathered a period that was perhaps quite frustrating. This is a large embedded fan base. This is a club that has a group of fans as large as some of the top teams in English football, and perhaps as anywhere else in the world. It's a large community in Birmingham and certainly in the Midlands generally. And so this support within the franchise and the community allows us a base of fans to really build upon. And what we need to do now is put our fans and our stakeholders first by creating a product that they can enjoy and feel proud to support. So what that means is bringing in, the best talent that we can within EFL guidelines and rules. It means investing in the stadium and the fan experience. It means investing in the women's team. It means investing in the training facilities in our academy. So when I say the buck stops here, ultimately we've got to make an investment, and we have to do better in every element of the entire organization. We knew that going in. It was part of what made this attractive, was that there was so much opportunity, but we know there's a lot of work ahead.
And we know that this isn't your first foray into sports. You've teamed up with Tom Brady on pickleball as well. When you're assessing the sorts of sports assets that you want to go into, how are you picking them?
I think at the end of the day, and it's like any other investment, we're looking at relative opportunity, and we look for investments that have a lot of asymmetric risk, right? Where especially when we can play a role in the transformation or reimagination of a particular situation. So with pickleball, we saw something where there was an incredible amount of enthusiasm across the country. This was a sport that was certainly on the rise. And to have an opportunity to buy one of a limited number of franchises for the teams within Major League Pickleball was an incredible opportunity. And certainly to do it with somebody of Tom's stature and with his incredible level of success in one of the most difficult sports in the world made him a prime partner to think about, embarking upon the pickleball venture with.
Tom, one last question from me. It's not a secret that this is a difficult macroeconomic environment. Money is expensive, but here you are doing a huge deal. So what does the macro sort of mean for Birmingham City moving forward and for Knighthead at large?
I think sports investments can be largely immune to macroeconomic cycles. Fans, often turn to sport in periods of difficult times economically as something that is not overwhelmingly expensive and can provide them with a great deal of enjoyment. And their engagement with the team can come in many forms. It doesn't necessarily have to be on match day at the pitch. It can be, digitally. It can be through the purchase of products. So that connection, if we deliver a good product, can be one that really endures those economic cycles. And I think when we think about our investment in the club, we're thinking about it as more than simply, buying into a team or a collection of teams between the men's team, the women's team, or other teams in the academy. It's about making an investment into the community. And, as we think about this investment going forward, we're going to be looking for ways to build on that investment and really help continue the transformation of Birmingham into a very, very exciting place to work and live. We want to deeply embed ourselves and the investments that we make within that community for sure.
Now, as an Arsenal fan, it's bittersweet. I want to be able to root for Birmingham City Football Club for your sake, but it's tough. It's tough. But congratulations again on the acquisition.
You're wearing the right colors, so we appreciate that.
That's true.
Thank you.
A big thank you there to Knighthead Capital Management co-founder Thomas Wagner and our very own Ali Garfinkel. Thank you both.
Thank you.
Well, you're very welcome. Well, amid the surge in tech stocks, small caps and government bonds, one asset class isn't participating in the latest run-up. Bitcoin has held a tight trading range over the last 3 weeks as the industry braces for a critical decision in federal court, where Grayscale Investments, the manager of the world's largest publicly traded crypto fund, is suing the SEC to allow a spot Bitcoin ETF to operate in the US market. Yahoo Finance's Jared Blickery is here with those details. Hey, Jared.
Hey there. And I thought before I got into the court case, I'd just begin with a year-to-date look at what's happened in cryptocurrency land. Bitcoin up 85%. But as you said, Rochelle, we haven't seen a lot of that price action made recently. This is let's get a year-to-date chart on there. And you can see over the last 3 weeks, basically treading water going sideways. However, given the fact that we are in the upper right-hand side of this chart, this consolidation is actually bullish. And when you see what's overhead, let me put a 3-year chart. The most price action in Bitcoin is lying directly ahead, and that's basically 30,000 to 40,000, goes up to maybe 50,000, but a ton of price memory in there. So not surprising to see Bitcoin at least taking a pause, and it could still reverse. But back to the main point, this court case that we were talking about, Grayscale versus the SEC, they want to sue the SEC in order to allow them to convert into an ETF. They are currently an ETN. It gets into the weeds there, but they want to be able to be based their reference price on spot Bitcoin. And we saw, in anticipation of a decision of that in this case, we saw BlackRock file for a Bitcoin ETF, a spot Bitcoin ETF, only a few weeks ago. Then a bunch of other issuers piled on. Fidelity did as well, and they just filed an amendment only today or yesterday with regard to their previous amendment. So things are moving along there, but is it going to be approved? Is the spot Bitcoin ETF going to be approved on its own merits, or is it going to be forced in, shoehorned in because of this court case? We don't know. But nevertheless, Bitcoin poised, I should say, to break higher. But as we know in crypto, anything can happen.
It's true. Always waiting for that breakout moment here. Still waiting for it. But thank you for getting us up to speed. Our very own Jared Blickery there. All right, taking a look at Delta stock moving lower, erasing some of this morning's gains. That's after reporting strong second quarter earnings. You can see they're just up slightly now again. Now, was it something in the earnings call that turned investors off? Well, let's find out. Joining us now with his take on Delta's earnings is our very own Brad Smith. Hey, Brad.
Hey, Rochelle. Yeah, we've been tracking shares of DAL throughout the morning here, and this coming off the back of their Q2, or as they call it, their June quarter results here. Now, they beat on top and bottom line estimates, plus raised their guidance as well. And so the street and pre-market was reacting positively to that. But would those gains be held on to? We also saw Delta touch negative territory here on the day. So that got us thinking what was taking place on the call. Here's a little snippet of what the CFO, Dan Jenke, had to say.
If you look back to last year, I think that's the more important comp. When you see the deceleration from 1 to a midpoint of -3, last year's international RASM went between 2Q and 3Q was up 16 points as the travel restrictions went off in 2Q. So that had that big surge in demand on a limited capacity last year. So I think we're looking at a 2Q to 3Q that's really right in line with what we think the seasonal norms are.
And so it seems like the markets may have paid a little bit of attention to that seasonal norm. And the seasonality returning is something that actually came up in my conversation with Delta CEO Ed Bastian about this quarter's results as well here. Because if that seasonality does return, well, one of the other things that investors would be watching for was and will be going forward, what does the growth normalization look like for a company in Delta? Now, Ed had told us as well in conversation that they are continuing to see a strong amount of the premium consumers out there really leaning into what a priority for spend is and an extreme travel experience, as he called it. But going forward from this point, even as we think about what that growth profile and that prospect looks like, it's going to come on a few things. It's going to come on a new cohort of consumers, a younger cohort of consumers. The average SkyMiles member that's been signing up, according to what they disclosed, and they did have another record quarter of those signups for SkyMiles members, is about 10 years younger than what they had seen in prior quarters. And so that signals that we're going to have a younger travel cohort and consumer that they're going to be looking to battle for the attention of in their own travel experience. But then additionally here, you just think about the number of routes that they're also going to need to make sure that they put forward at a time where, yes, this is a very tough environment for a lot of airlines to make sure that they are still not only bringing up capacity, but satisfying the customers on the routes that they fly. And oh yeah, making sure that those routes are flown on time, without cancellation or without delay. And Delta, just lastly, as we close out this conversation, from the prior year, they reduced cancellations over the Memorial Day period. Ed Bastian noted that to us from the prior year. They had 800 cancellations over that long holiday period to this past year, and they had 8 over the July 4th long holiday period. They operated over 21,000 flights within a completion rate of 99% there, Rochelle. So that's going to be something that consumers continue to pay close attention to. Not only am I boarding the flight, but am I getting there on time?
I mean, hey, otherwise, what's the point, right? Do we know that did we hear anything about business travel? I know we've talked about some of the nuances in business travel, which, not your typical person with a briefcase, but more, your construction worker, and how that didn't really stop even during the pandemic.
Yeah, I'm glad you brought that up, because that was one of my questions to the CEO Ed Bastian was about corporate travel, and are they seeing that come back, or does it need to come back to pre-pandemic levels? And he said, no, it might not need to, because there's such a changeover in the makeup of the type of traveler now. You've heard this term by now, bleisure, and this is kind of a business and leisure travel mix, or muddling together of where some of the people who are able to still work virtually or work from anywhere, where they're hopping on a flight and saying, all right, well, if I don't need to work from the office, I'm not going to work from my couch. I'm going to work from somebody else's couch on an Airbnb in some destination that I've always wanted to go to. And so all of those things considered, I think it's changed the makeup of the type of corporate or business traveler. At the same time, while corporate travel is coming back and is resuming, conferences that we're seeing people attend more of, or just going to business meetings, but not as many of those business meetings are taking place at physical offices now. And that's something that the CEO had also alluded to and mentioned in our conversation. And so that perhaps changing the makeup of the type of corporate travel we're seeing.
Well, I'll be sure to step up my bleisure wear from now on to reflect these changes. Always great to get your take on everything. Our very own Brad Smith. All right, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
How would you describe the consumer right now?
I would say the consumer is bending but not yet breaking. When you think about the bend, certainly excess savings have been spent down pretty much when you look across all income quintiles. When you look at 401k hardship withdrawals, we're getting anecdotal evidence that some folks are tapping on those to potentially fuel some of their spending. But they're not necessarily breaking, right? They're still spending. If you were to look at, we talk about revolving credit debt in aggregate, and I know the number is a scary number, but if you look at it as a percentage of disposable income, it's actually below where we were prior to the financial crisis, and it's creeped up a little bit, but roughly where we were at just right before the pandemic. So I think we're seeing a normalization in credit usage, not necessarily consumers coming overextended. So I would say consumers are bending, but not yet breaking at the moment.
Barbie's big box office debut could give retailers a boost, at least according to our next guest. Roth MKM says the buzz around the film could drive traffic to stores like Five Below in particular, citing previous successes from blockbusters like Frozen. The analyst behind the call is David Bellinger, and he joins me now. David, good to see you here. So from an investor perspective here, how should people be approaching Five Below in relation to the success that we might see with the Barbie movie?
Yeah, thanks for having me on. So Five Below historically has been one of these companies that's drafted off new intellectual property very well. We saw some precedent with this. You mentioned Frozen. We had the Super Mario Brothers release over the Easter weekend that was much better than expected from a domestic box office standpoint. And Five gets ahead of these trends. They fill their stores with a number of items. We're in the stores a lot. We've come across 30 plus licensed Barbie items. Well, that's not material, just given that Five Below sells thousands of products within their store. It could generate enough buzz via social media and other means to get people in the store. They really discover the Five Below brand. They shop other categories and they come back. So we've seen that historically too with things like fidget spinners and other crazes. And that's what really unleashes the power of the Five Below model and gets them a nice new customer base that continues to spend well.
So would this be the best time to get in then to Five Below versus sort of, obviously the movie is coming out shortly, or is it best to sort of wait and see as we have more blockbusters also coming out this summer?
Yeah, there's clearly a new slate of movies that's come out that we haven't had over the past few years. There's a Paw Patrol movie coming out as well. But look, I like Five Below. This is a long-term growth story. Some of these smaller catalysts, they're not a huge deal for their stock, but they could help out in some type of way. And we'll be keeping a close eye on this Barbie release and the box office numbers as they come in. I think it could be a nice positive. But if you step back and just look at the growth potential of this model, going from 1,200 to 3,500 plus stores, this company is on a real nice trajectory to get to somewhere of 5 billion plus in sales. And you could easily see earnings power go from between $5 and $6 per share this year, upwards of $10. And that's what I think gets investors really bullish on this name. And it's not just a single quarter or two. This is a nice long-term trajectory here.
And who would you say would be the main competition for Five Below when it comes to some of these licensed products from the Barbie movie and some of these other big franchises?
Yeah, it's an interesting question. So your big retailers, your Amazons, Walmarts, Targets, they sell a lot of this product, but there's no one out there that's really the last true comparable for Five. You had Toys R Us go away, and they're really one of the last kids retailers within the US, and they get ahead of these trends, and that's what's really helped them. They've been able to garner much more product, much more inventory. They've got a great relationship with their suppliers, and they want to be part of this long-term growth algorithm, right? They know Five's coming out with big new store growth numbers. They want to invest behind that, get their inventory in these stores. So Five's really leading the category up in alone, really, in terms of themselves, but they do pry away from some share from these bigger players, and their low price points are a clear way of doing that.
And you raise a good point. I mean, I have a 9-year-old. I'll be lucky if I can leave Five Below just spending $5, because as you mentioned, once you get them in the door, when you used to have a Toys R Us everywhere, now there's Five Below, and you sort of have multiple things you can spend on there. Talk about Five Below's expansion plans when it comes to especially sort of children's retail or some of these more trendy, some of these trends that they're able to capitalize on in a way that some of these other stores can't.
Yeah, I've got a 4.5-year-old daughter, and I'm in the stores a lot as well, spending a lot of money too. So I think what they really do well is these relationships with suppliers can pick off trends early. And in my checks, I've seen hot items like collectibles, Pokemon cards, sports trading cards. I mentioned those fidget spinners a few years ago, and it really creates this halo effect around the business. And Five has sort of become the home sense for kids. It's this treasure hunt. It's got a nice discovery piece to it. And like you mentioned, you're not just buying one item. You might build your basket and spend anywhere from $15, $20, $30. And then just not knowing what you're going to find, that treasure hunt feel, that's what keeps you coming back. And Five has garnered a lot of new customers. And I think they're driving a lot more of their organic traffic now. They're driving their traffic more organically as opposed to drafting off other adjacent retailers. So that's really what's in their DNA, and I expect that to continue for years to come.
And as we've seen, though, as people have been tightening their purse strings, not all value plays are created equal here. So are there any risks that you see for Five Below that people should be aware of?
Yeah, I mean, just a broader spending pullback, right? There's a partially a lower income consumer that could shop these stores, so that's a potential risk factor. You also have a little limited visibility on these movie releases, right? You don't know if Barbie's going to be a hit or not, so that could create some volatility. But overall, in my sense, I feel as though consumers have been trading down somewhat, right? You might not buy that $30, $40 toy. You might buy a $5 to $10 item. And Five has this great value flavor to the business. They've expanded into these 5 Beyond products, a new concept in their store. I've seen items upwards of $25. But even though that might be a higher price point, those have continued to sell well because just the value differential versus what you might find at Amazon, Target, or Walmart. There are a lot of also exclusive products that 5 sells, and they've really tapped into that core customer, and they've held on to them really exceptionally well.
Well, there you go. I'm sure consumers will be saying goodbye to their money, but at least some good news for investors here when it comes to Five Below. A big thank you there to David Bellinger, Roth MKM Consumer Growth and E-commerce Senior Analyst. Thank you for your time this morning.
Thank you.
Well, we've got another positive inflation print this morning. The producer price index rising less than expected, up 0.1% from May, while the street expected a 0.2% pop. This, of course, after CPI came in at its lowest level since March of 2021. So does this pricing data put a damper on the Fed's hiking plans? Jill Malandrino, Nasdaq Global Markets reporter, is here to weigh in on all of this. So, Jill, what are your thoughts on this inflation print?
Well, it's certainly the latest sign that inflation is calming in the United States, bolstering the case for the Fed to step back from its aggressive policy tightening campaign after an expected interest rate hike next week. This follows on Wednesday's CPI data coming in lower than expected. The macro team at LPL Financial expects the Fed to not only end its rate hiking campaign toward the end of 2023 as inflation abates, but also introduce the possibility of a rate decrease. A cut in rates and a recession could happen should consumer demand and job growth cool and unemployment rise, as all three are expected to do. LPL believes if inflation convincingly cools, markets will likely respond favorably to the Fed lowering rates. So far, an improving Chinese economy hasn't materially impacted global inflation, which is a good sign as well. It is important to note, however, that backward-looking data has tended to surprise to the upside, while more of the forward-looking or survey-based data has told the opposite story. The Fed's inflation target is 2%, and it is nowhere near that. Core is still at 4.8%. The CME FedWatch tool, which analyzes the probabilities of changes in the Fed rate, shows that there's still a strong likelihood that a hike will take place during the July meeting. Fed Chair Jay Powell's press conference following a rate hike announcement will be highly scrutinized as investors will try to discern if his comments remain hawkish.
Now, Joe, we also got new jobs data this morning as well. Jobless claims shrank with 237,000 initial claims found. What do you think about this jobs data and what it says about the health of the economy?
Well, let's go back to the non-farm payrolls report for June that we saw last Friday, because that really is the key piece of data. We saw an increase of 209,000 jobs in June, but persistently strong wage growth pointed to a still tight labor market. And the Fed watches wage data because it worries that if pay growth remains unusually rapid, it could make it difficult to bring elevated inflation fully back to their 2% goal. This data showed the 30th consecutive month of gains in American payrolls, but the June figure represented a continued cooling of the labor market, which will be factored in the Fed's interest rate policy. Now, June is typically the strongest month for jobs growth due to seasonality, which students and teachers offer the summer looking for seasonal employment. So if June, which is strong, showed a slowdown in jobs, it could indicate a downward trend is forming. 1 month is not a trend make, so we'll have to see how that plays out. Now, slowing inflation and labor market demand easing is positively received by the market because it's perceived that the Fed will adopt a less hawkish stance. The key as it relates to job, though, we have to get the wage growth to come in.
Well, let's look ahead. What do you think we can expect from the remainder of the second half of the year, given how strong the first half of 2023 has been so far?
Well, the narrative for the first half of 2023 was simple. Results were better than expected. The labor market was strong, consumers and businesses stayed confident, and the economy grew despite challenges in the banking sector, which had the potential to derail this progress. All market indices were up, corporate earnings beat expectations, and while growth slowed, financial conditions remained steady and inflation is dialing back. Now, for the remainder of the second half, we have to acknowledge many of the risks that existed at the start of the year, including the possibility of a recession that is yet to materialize. They still exist. Brian Price, head of investment management for Commonwealth Financial Network, said when you cut through the noise, there is positive data. Economic growth looks poised to continue. Market tailwinds, particularly earnings growth and potentially lower inflation and rates, they're blowing. Those tailwinds are there. Brian believes that growth will almost surely be slower, but that slower growth could mean lower rates, which of course will help support the markets.
All right, always good to get your updates. Big thanks there to Jill Malandrino. All right, well, a relaxing retirement may be a pipe dream for some, with a new survey from Transamerica Center for Retirement Studies showing that 55% of people plan to continue working after they retire. Yahoo Finance's Kerry Hannon is here with the details. That's unfortunate. That's sad. I mean, is this a must?
Well, I tell you, I personally don't think work is a bad thing. There's a lot of good reasons to keep working in retirement, but this is noteworthy because it's across generations. People are saying, hey, we simply aren't able to save enough for retirement right now. We don't have enough income. There's sort of this, pervasive pessimism out there about outliving their savings. And so it appears to me to be a bit of a default reaction saying, well, you know what? I'm just going to keep working in retirement. Maybe not pedal to the metal, but there will be part-time work, and some are saying full-time, but shockingly, 15% did say they expected work to be their primary source of income in retirement, which really surprised me. But here's the thing, it's the first time people are actually thinking about work and starting to put it in their head that you're not going to just have a cold stop at 65 or whatever year you may be bounced out of the workplace, which does happen earlier if you get a layoff and hard to get back in. So, but the number one reason people say that they plan to work in retirement in some fashion is because they're concerned about Social Security not being enough. The second reason is because they're worried they're not going to have enough income, enough savings in order to support their lifestyle in a comfortable way. And the third reason is to pay for health expenses, which you and I know is going to be a huge ticket item as people grow older. So those are the reasons we're seeing people thinking about it. The problem here, why we say pipe dream, why you said that, is that employers aren't quite getting that yet. They aren't set up for these phased retirements, flexible work, letting their staff, kind of shift into less stressful work and, adjustable hours. They're not quite there yet. They're starting to understand that they need to offer this to retain employees because of what? Rochelle, this is huge. The demographic shift is noteworthy, and there has been a steep drop in fertility rates. And so they're starting to feel the fact of a tight labor market. And in fact, they actually need some of these older workers to continue to work, because I think what we're seeing, this transformative thing in the workplace, is by 2030, there are going to be more people over 65 in the United States than under the age of 18. This has huge implications in the workplace. So I think employers are going to start to get this.
I mean, and I get that. My dad retired and came back to work. He loves what he does, and he's 80, and he's like, yeah, no, I'm good. I'm just going to keep working. So then for people who are thinking, how do I prepare for longer working lives? What should they know?
Right. So it's not all doom and gloom. I mean, it's really important that if you are earning some income, even if you saved appropriately, it keeps you from having to dip into your retirement accounts. You can push back your Social Security benefit to age 70. But what you need to do, if you want to keep working in retirement, by all means, you've got to be prepared. You need to keep your skills up to date. You need to add certificates and maybe even a degree if you need to. You have to be sharp. You have to be lean and mean and ready to take on work. No one's going to, you're not a charity case, so you have to perform. You have to stay healthy. One of the main reasons people step out of the workplace is for health reasons. Pay attention to exercise and eating with an eye to nutrition, and do some scoping around. Start early, 5 years before you might retire. But what would you like to do? Do some volunteering, some moonlighting, try a few things out. What might be work that you can go to? So let's look at it as you're not retiring from something, you're retiring to something, a new form of work that actually can be great for you financially as well as psychologically. So I hate to be such a Susie upsider here, but I do see the upside in it.
No, but I like that. Retiring to something. It puts a different spin on it versus, it's end of an era versus actually have something to look forward to and some shifts that I can enjoy. Great stuff, as always. Our very own Kerry Hannon. Thank you so much.
Great.
All right, well, let's get you a final check of the markets as we head into the noon hour. Still seeing green across the board here, although that buying action slowing down significantly for the Dow. They're now just up about 37 points, or about 0.1%. The S&P 500 there up about 25 points, or about 0.6%. And also the tech-heavy Nasdaq, they're up over 1%. We're looking at more signs of cooling inflation here, so lifting, but obviously a little bit of uncertainty as to what the Fed will do next. Still expecting that rate hike at its July meeting, but from there, not quite so certain, so a little bit of a holding pattern here this morning. Well, that'll do it for now. I'm Rochelle Akufa, but I'll be back with you. Stay with us on Yahoo Finance.